All right. Good morning. I think we're all ready. Welcome to the Financial Accounting Board in Norwalk, Connecticut, for another meeting of the Transition Resource Group for Credit Losses. As a reminder, today's session is audio and video recorded, and it's being live broadcast today. It'll be archived and available for replay. So it's important when you're speaking, and I always forget to do this myself, turn the mic on, speak into the mic and very close to the mic, and then when you're finished, turn it off. So as a test, I'm going to go ahead and ask everyone to give their names and affiliations, and I'm going to start to my right.
Great, thanks, Al. Damon Romano, FASB staff.
Chris Kreiderman, FASB staff.
Doug Jepson, FASB staff.
Christine Bodison, FASB.
Wes Bricker, SEC.
Sydney Garmong, Crow.
Brian DeGano, PCAOB.
Joanne Wakeham, Federal Reserve.
Jeff Gear, OCC.
Bob Storch, FDIC.
I'll come to you, Bob. Hi, Graham Dyer, Grant Thornton.
This is why we test things here. Yeah.
They don't want you to talk.
Mark Northen, KPMG.
John Howard, Deloitte.
Shihahu TD. I just have one comment. I'm very nervous sitting around the big four firms.
Chip Curry, PwC, and we're all friends here. All right.
Kevin Guckian, EY.
Helen Kellogg, Bank of Montreal.
Russ Golden, FASB.
Diane Bellis, Allstate.
Gary Busef, FASB.
Dan Pelamaki, Citi.
Kevin Staclosa, M&T Bank.
Mario Mastrantoni, Wells Fargo.
Jim Croker, FASB.
Susan Hannigan.
Marcia Hunt, FASB.
Trent Lafrano, FASB staff.
Jay Shaw, FASB staff.
Sue Cosper, FASB staff.
Shane Gahanik, FASB staff.
And I'm Hal Schroeder, member of the FASB. Before we get started, Shane and I have a few opening comments.
Hal, it's Tim Zimmerman with Standard Bank on the phone here.
Thank you, Tim. I did have you listed as on the call, and I apologize.
No problem.
We want to get started with a few opening comments. Today's our third meeting of the TRG. We had, since the standard was issued, this is our second one this year. And during this time, the board and staff have been focused on three work streams. And we talked about these last time: education, monitoring, and of course, implementation. And since our last meeting in June, we've been hearing a lot of different things. One of the ones that's really stood out in my mind is the parallel testing. And in fact, I was at a conference last month dealing with community banks, and I was really struck by the number of community banks that are already in parallel testing. So it was a really good sign that people are stepping up and taking the standard very seriously. We've also heard on third quarter conference calls that many of the others are preparing for 2019 to start their parallel testing. With this timing in mind, we scheduled this meeting late in 2018 as kind of a cleanup to make sure there are no other outstanding issues. And fortunately, we have a relatively short list of things to go through today. And Shane will start kicking that off in a moment. But before we get into the list of things on the agenda, I did want to talk about one thing that wasn't on the agenda. It's an accounting alternative that's been floated by a few banks. In the last 2 months, I've been asked about it at the AICPA Banking Conference, a major investor conference. Virtually every investor meeting I've had in the last few weeks has asked about it, and several other discussions. The alternative has been prominently mentioned in recent comment letters those banks have submitted to the regulators. The focus of those letters has been primarily regulatory capital, but as you know, even though we have no authority and it's not within our scope of authority, we do listen to discussions about regulatory capital and other issues, so we've been paying attention to the developments in that area as well. The alternative that was discussed also at there was a roundtable hosted by 3 congressmen in Washington back on September 4th. At that meeting, what I heard and what I told the banks is that they could submit this proposal to us, and that if you're following our rules of procedure, you can submit that proposal, and that while we're not required to consider it at a board table meeting, we would, with Russ's approval, just checking with Russ, he hadn't changed his mind, okay. Russ said that we would have an open discussion at a board meeting to review the alternative and discuss it. As I understand the alternative, and it's a very high level, it would maintain what the banks that are suggesting this have called a CECL compliant allowance. And the allowance would be comprised of two components. I'm just making sure I use the right words here. Charge-offs expected to occur in the next 12 months and charge-offs expected over the remaining contractual life. Subsequent changes in the allowance of those components would be recorded as follows. 12 months of the charge-offs would flow through net income, and the remainder would flow through OCI. And at the September roundtable, I reminded the banks and the other participants at that meeting that we had considered that alternative and several very similar alternatives. And we had basically, heard feedback from the banks at that time when we were considering that alternative that this would actually be very difficult for them to do, and in many ways it would be very costly and arbitrary. So weighing that feedback, the board decided to not split in any way the bifurcation or have a bifurcation of the provision. I also mentioned that at the time, investors had suggested, very strongly encouraged us to do a bifurcation of the provision, but along the lines of loans originated this period versus loans, changes in estimates from prior periods. And again, all those types of bifurcations were strongly opposed by the banks on a cost-benefit basis. As of this morning, I'm going to be clear, we haven't gotten any response or any letter at this point, okay? We've not received it, but I have on very credible source that we will get it in the next few days, if not this week, certainly next week. And I've been told the letter will provide more detail on the outline that I just gave you about what the alternative is, and that, we'll just wait to see how the letter comes out. What I will tell you at this point, assuming that we get the letter, the next steps for the staff would be to digest the alternative and then conduct outreach with those banks that sent the letter to address any questions that the staff may have and gain an understanding of what's changed since we considered this about 5 years ago. What's changed in the last 5 years that would make this more operable or cost beneficial to do? And then we'd also probably, at least I would hope, that we would consider some of the alternatives the investors had mentioned at that time, again, going back to the splitting of the provision between originations and changes in estimates. Again, we'll see how the letter turns out when we receive it, and we will keep you informed as things develop. So at that point, I'll turn it over to Shane for any additional comments.
Thanks, Al. Good morning, everyone, and welcome to Norwalk, Connecticut. It feels like it's only been a few months since we last spoke. So it's like family now, almost. So we've got a lot of great topics to talk about today. We tried to highlight in the cover memo the significant outreach that we've done. So I think the first thing I'd like to do is, on behalf of the staff, thank everyone here, obviously, for their participation, and for those that aren't part of the TRG that provided outreach comments to us. We are grateful because it does make the process a much better process, and the outcome is obviously a much better product. So thank you for that. I would like to note, for those that are watching online, as Hal mentioned, this is webcast. We do have the memos posted online under the TRG webpage, so I would encourage you, if you are watching and you haven't downloaded the memos yet, to please go to the website, download the memos, because inevitably during the discussion we will probably point to a specific paragraph within the memo, and if you have it in front of you, it just makes it easier to follow along with the conversation. Just a couple of administrative matters. I know that it's only been a few months since you were here last, but we're going to try to keep this orderly. So if you want to ask a question, simply take your name tag, stand it up like this. I've only attached a fishing line to Chip's name tag, as he mentioned before, so I can pull it off the table. I'm just kidding. But we'll try to keep track of the order of people that stand up their name tags so that we can have a conversation. If you do have something that's pertinent or right on point to the last person that spoke, just kind of give me a sign, and I'll let you jump in ahead of the line. But if, as I mentioned, I think at the last TRG, if you start to take advantage of that, we can rescind that privilege just as well as we've given it. This meeting will be archived online, so if you don't have the next 6 hours of your day to carve out to watch us, although I can't imagine why you wouldn't, You can watch it later on as that meeting will be archived. And then this discussion, the staff will prepare meeting minutes that will be posted online once the discussion is over with. And that will be in the coming weeks, obviously, as the staff digests the discussion here, writes it up, and then allows, obviously, for the TRG members to provide comment on those meeting minutes. There are a couple of updates that I'd like to give you. As some of you know, we have been a little bit busy the last few months since we last met. So we have a final ASU that will be published probably in the mid-November timeframe. That final ASU deals with the non-PBE effective date, where we align the annual and the interim periods that the standard will become effective, and also clarify the scope for operating leases with respect to topic 326. That will be it's in our process right now. It'll be finalized and actually published in mid-November. In addition to that, we have another codification improvements document with respect to CECL that will cover off on many of the topics that we discussed at the last TRG meeting and the TRG meeting prior to that. We've made codification improvements. That document will also include codification improvements for hedging and recognition and measurement. So it's a pretty comprehensive document for financial instruments. That exposure draft will go out in mid-November, right around the same time frame as the previous final one that I just mentioned, and that will have a comment period of 30 days. So we encourage you all to look for that, and please comment on that, as obviously we consider that to be valuable information. We have a tentative board meeting scheduled for next week to address any of the issues that come out of this TRG meeting that may need the board to come back together to discuss, so that we can incorporate that the feedback from this meeting that you all observe need codification improvements or maybe tweaks to some of the stuff that we have in the ED that will go out in mid-November. So that mid-November ED that I just mentioned will incorporate this meeting. And so that will go out as a complete document. So it's, we're not going to go out the door with something that's incomplete and then have to do an additional one in the first quarter. We are cognizant of, obviously, parallel runs in 2019. Finally, we do have a meeting scheduled again for mid-November, I think the 14th, if I'm correct, right? To discuss fair value option agenda requests. So as many of you are probably aware, we got a couple of requests to address fair value option for transition relief. And just briefly, it's our understanding that there are institutions that are interested in electing fair value option for new instruments going forward that are in the scope of topic 326. This obviously would create a situation where you have fair value on the new book that you've elected, but you would have amortized cost on the old book, because obviously fair value option is only allowed at specific time frames, two of those being at origination or purchase of the loan. So we will be discussing, so the agenda request is to actually be able to, at transition, have a one-time transition relief to elect fair value option for all of the old books, so you have comparability. There was another agenda request that also talked about being able to unelect fair value option, and that will be discussed as well. So the entire fair value option agenda request will be discussed on November 14th. For those that are interested. With that, I think that's all of the administrative matters and the updates. I'll ask, does anybody have any questions on those items? Okay, looks like we have no questions. So with that, I'm going to turn it over to Chris to kick off our first issue.
Thanks, Shane. Good morning, everyone. Memo 14 provides an update on a technical inquiry that the staff has received and three TRG submissions. The staff will provide our views related to these TRG submissions. However, the staff has not prepared individual memos for these submissions, as the staff believes that either the current guidance on these topics is clear or the topic is beyond the scope of the TRG. I'll first introduce a recently received technical inquiry along with the staff's response. A stakeholder raised a question related to the disclosure requirements for credit quality information, commonly referred to as the vintage disclosure. The stakeholder noted that in example 15 of the implementation guidance, current period gross write-offs and recoveries were separately disclosed in determining the net write-off amount for each origination year. The stakeholder asked whether the amounts of gross write-offs and recoveries are required, as the disclosure guidance for the vintage disclosure does not specifically require these amounts. The board intended for the vintage disclosure to provide financial statement users with the insight into management estimates of the allowance for credit losses, to understand credit quality trends within the portfolio from period to period, and how the individual components of the allowance, like write-offs, are changing each reporting period. The staff notes that displaying gross write-off and recovery amounts by vintage year allows financial statement users to better understand management's initial and revised estimated losses of estimates, which meets the disclosure objective of the vintage disclosures. The staff also notes that gross write-off recovery information by vintage year enables financial statement users to track cyclical trends and create loss curves that can be compared to an entity's expected loss amounts. The staff believes that omitting the information needed to track management estimates could decrease the value of financial information provided in the vintage disclosure. Based upon these reasons, the staff believes that it was the board's intent to require disclosure of gross write-off and recovery amounts by origination year in the vintage disclosure. The staff has the following question to the TRG. Does the TRG believe a codification improvement is required to topic 326 to clarify the board's intent that gross write-offs and recoveries are required to be presented by origination year within the vintage disclosure?
I won't, I'll let somebody else opine on whether it needs codification or not. However, I just want to emphasize the importance of this disclosure being a requirement, because as a user, without the gross write-offs and recoveries, it's going to be impossible to really do the roll forward that we need to be able to do to analyze the underlying credits of the companies.
Marriott? Okay.
So I would think if it is going to be required, there does need to be a codification improvement, especially since I think the lead into example 15 says, here's an example, it could be more, it could be less. So if it is going to be required, I think you do need a codification improvement. I guess one question I had, and this is not my area, but I'll ask it anyway, is do we really feel like this should apply to everybody? So retailers, I mean, is that something that would be meaningful or not? Certainly in financial institutions, that would be a meaningful disclosure, but I just wonder if it is going to be required, we need to think about all industries.
All right.
Just to reiterate a little bit of what Sydney said, I think the guidance as it's written today says it's an example, right? So this is just an example. The example could be more or less detailed, so it's clearly not a requirement. I think we also have to be cognizant of the fact that the existing credit quality disclosures follow that guidance. So to the extent you don't make a codification improvement, the implication is that all the existing credit quality disclosures that we're making are not compliant with that example, because we've all taken our own interpretations of what's the best data that we have, what's the most appropriate way to depict the credit risk. So I think it creates other issues that have to be considered. In addition, and speaking for my own organization, but I suspect it's the same in others, is we don't capture gross write-off and gross recovery data by vintage, so we couldn't produce it if we had to today.
We have heard some similar feedback from our client base to what Mario said, that the systems don't currently capture that information by vintage year. I think we would agree with Sydney that if this is going to be a requirement, that should be in the guidance as opposed to in examples. I think the examples are generally, for disclosures, designed to provide exactly that, an example of one way that it could be done. And so if it's going to be a requirement, we do think that we should do a codification improvement. We do think it should be exposed for public comment and go through that process.
So in summary, I'd say,
Sorry. Yeah, really probably just echoing the comments that Mario made and Chip as well. I mean, this, from our perspective, it's a surprise. We were not, planning on making this disclosure. And so, we'll have to begin to manually pull together this information and then, build a systematic process to do that. So it will be difficult, to fold this into kind of the parallel runs that we'll do from a disclosure standpoint. And typically, we try and do a parallel run for 2 or 3 quarters before adopting a new standard. So, it is a lot of work to do at this stage. So, clearly think that we need to the extent that this is going to be a requirement, we need to make that clear within the standard itself. Otherwise, I think it sets a difficult precedent for other illustrative disclosures that we have, in many other FASB standards, where it is illustrative, and we don't necessarily provide each aspect of those example disclosures. So when we started to map this out, the table itself is going to get quite busy as we explode it out by each individual type of loan. So there's going to be a lot more information in there. And when we go through and look at corporate loans, there'll be a number of parts of the table that will have very small dollar amounts as well. So we're thinking our way through that. The recoveries and charge-offs, I think, speak more to the allowance as opposed to the amortized cost balance of the loan itself as well. So I'm not sure, the placement in the vintage table versus where we have disclosures from an allowance perspective. So from a placement standpoint, there's probably some considerations there. But a lot of the challenges that we all were focused on when we were looking at doing a roll forward of the amortized cost, I think that's part of the considerations, collecting this information as well. And I guess one final observation from our perspective, when we think on the retail side, a large portion of our charge-offs and our recoveries do relate to credit cards. And so given that that's, a line of credit, a revolving situation, that will not go through, the vintage disclosure itself. Thank you.
Is going to be operationally difficult to, particularly with recoveries, pull back through, and you're going to end up with lots of recoveries either in the revolving category or in the prior category, because recoveries often come back years and years later from when you have actually charged it off. So oftentimes they're treated on different systems, and so reaching back into those years is going to be a challenge for, I think, a lot of institutions. Obviously, you've heard from large banks. I think that will be the case for smaller banks and credit unions as well. So I think this will add to the operational complexity of a already pretty complex standard, and so I think that needs to be considered in terms of how we approach that, and if there are any practical expedients that can be done on a look-back basis in that regard.
Okay. And just a question here, both Mario, Dan, and yourself. Is the gross recoveries or the gross charge-offs the more complex component of?
I think from my perspective, it's the recoveries, because charge-offs are somewhat complex in that you still have to reach out, and oftentimes it may be on different systems, but it's easier to connect the charge-off with the loan. Recoveries come in, and can come in years later and at some point in time, they can be 10, 12, 14 years later that show up, and so that becomes more challenging, I think, from the charge-off perspective, but I'd also.
Dan, Mario?
Yep, totally agree with what Doug's saying. And I think for us, it does depend on the type of portfolio as well. For retail, the charge-off information, I think, is going to be easier for us, but would echo Doug's comments.
Okay. But which loans you're charging off, right?
Yes.
And because of the vintage disclosure requirements in general, you'd know what the loan vintage was. So Is it that these are in different systems?
Yeah, and it, again, depends on the type of loans. For us, I can say, on the corporate side, a lot of this just gets booked, directly to the general ledger. It's not in our Optima loans processing system, so it's not systemically, tracked and monitored by Vintage. And so it's going to be a manual collection effort. We have to build a process around it.
The same thing, Mario? Okay.
At the instrument level, but you can't go into the system of record and extract that data by vintage. You could go one by
Gotcha.
one. You can't get it out.
It's like Dan said, it's the same issue that you ran into in why we ended up with vintage was because you couldn't do a roll forward of loan balances for the same reason. Fred?
Oh, I just wanted to say, I think while I'm certainly sympathetic to the systems and the data issues, I think the fact is that the time frame can be so different is why that information is important to users to be able to understand what's actually going on in the portfolio.
Right.
Thanks. So yeah, I agree that in the need for having a codification amendment. I think that sounds right. One piece of feedback we received that the staff may want to consider is that I think we're talking about loans. The way we're talking about it, we're thinking about a single charge-off event and then a single recovery event. But we did receive some feedback that there are some lenders who will take charge-offs, partial charge-offs over time on a single instrument, and the recoveries will also come in on a staggered basis on a single instrument. And thinking about how you do that in a vintage table, I'll defer to the institutions and whether or not that's a material issue. But if it is, that might be something worth considering in the drafting, is how you would link recovery to charge off in a vintage table, right?
Gio?
Yeah, one is to agree with Chip, so I have no choice. Is probably just to have it exposed. If this has become codification, I do think there should be public comment on this. And I agree with Mario, Dan, and Doug's point. But maybe one thing that I'd like to highlight is Dan's comments. Like if you disclose this as part of your allowance roll forward, your gross receipts, byproducts, and gross recovery, what maybe Fred can help a little bit. What the incremental value has to be by vintage, and what additional value is drawn upon that. And that's the part I don't quite understand, because those information are disclosed to a certain degree, but just in a different location. So what it has to be by vintage, I guess.
So the reason by vintage is important is because economic situations change by vintage and underwriting criteria change by vintage. So being able to project out what you're going to expect the future allowance to be, and what you expect, the way charge-offs and the allowance to roll forward, is really going to be determined by the timing of those events, which is going to be able to be told to us through the vintage disclosures.
But like we have later on, there's a different memo, right, on the what's called the line of credits converted into fixed loans. That by itself screw up your vintage to start with, right? So vintage by itself is not the criteria to do all the analysis. So that's the part I'm trying to say. What's the precision versus what information is already out there can help with analysis, right? Because if you go to the choices A, B, C, D, and E in the conversion to fixed loans, none of them give you quite what you have the right vintage. But those now fixed term loans turn from the line of credits. So how do you do those analysis when vintage by itself is not clear?
Well, we're jumping ahead a bit, but my view of that situation that we get to later is going to be that really what we would like as users is to know when the credit decision is made.
No, I understand. I like that view as well. But again, this one has system problem as well. No, it does. But what I'm saying is vintage is not perfect today. So if you go back trying to do all the old vintage to this information, we have to manually pull. That worth the efforts to do, because vintage by itself is not defined that clearly. We have to clarify certain vintage definition here.
That's a fair point, and one of the whole issues that as a user, as we move forward, is our understanding of the allowance is going to get better over time, and we recognize that the initial understanding is not going to be ideal because of some of these operational issues and consistency. So it's a fair point.
Just one final point. I recognize, Fred, there's a balance between what users want and what preparers can provide. So trying to find that line is always difficult. But I think it's important to note that I don't think anybody calculates their allowance by vintage. and you're asking us for information to permit you to calculate our allowance by vintage. So those two things don't seem to intersect very well.
Okay. To summarize, the TRG would be supportive of an amendment to the codification to clarify the requirement, noting that there are operational concerns if that information is required in the vintage disclosure, and if that disclosure is required for all entities. Is there anything else? Okay. Next, I'll introduce the 3 TRG submissions that the staff received that are described in detail in Memo 14. The first TRG submission considers 2 related questions. First, is an entity permitted to discount some but not all inputs when using a method other than a discounted cash flow method, or DCF, to estimate credit losses? Second, is an entity permitted to discount inputs to a date other than the reporting date, also known as partial discounting? To provide context on partial discounting, certain regulatory requirements provide guidance on how an entity should account for expected recoveries. To comply with these rules, certain cash flows expected to be collected subsequent to the default event are discounted from the expected recovery date to the default date instead of an entity's reporting date. Some stakeholders inquired whether they can use a similar approach when estimating the allowance for credit losses for accounting purposes. These stakeholders noted that using data that is readily available for regulatory purposes would reduce the cost and effort needed to comply with Update 2016-13 by more closely aligning the accounting and regulatory requirements. In the staff's outreach on these topics, the majority of outreach participants expressed concern that permitting an entity to selectively discount certain inputs but not others could be misleading and result in potential abuse. Most stakeholders also raised concern that discounting expected cash flows to a date other than an entity's reporting date would be difficult for financial statement users to understand and may result in diversity in practice. Although the board intended to provide flexibility when estimating the allowance for credit losses, the staff believes the board did not intend to align regulatory reporting with the amendments in 2016-13 in all instances. In addition, the staff believes the guidance is clear that if an entity elects to discount an expected cash flow, such as an expected recovery, all expected cash flows are required to be discounted. The staff also believes that discounting expected cash flows to a period other than the reporting date would not provide users with decision-useful information, as it would create additional complexity in understanding management's estimates of credit losses. Also, it would not be possible for the staff to determine which inputs should or should not be discounted because the guidance does not specifically provide which inputs should be considered when measuring the allowance for credit losses. As such, the staff believes if an entity elects to discount inputs in estimating credit losses, the effects of discounting would be measured as of the reporting date. I'll pause for any comments or questions from the TRG on this topic.
John?
I think our view on discounting is that you should probably only discount if you're using a discounted cash flow model. A little bit concerned about saying as long as you discount all the inputs in a model, that's okay, because some simplified models, like a PD-LGD model, if the only real thing that you could possibly discount is the loss, we feel like you're going to be reducing the allowance, and that doesn't seem to make sense to us.
Mark?
Yeah, a couple of things. First of all, I want to say I agree with the conclusion on partial discounting. I think, it's been our view that there's really only 2 options allowed in the standard, and they're very broad options, but there are 2 options. One is in 30-4 to discount the expected cash flows, and that would involve discounting all of the expected cash flows and then comparing it to the amortized cost basis. And then the other alternative, 30-5, would not include discounting, and it would ultimately have the goal of projecting undiscounted net credit losses. And so partial discounting, we think, would run askew of that for the reasons that the staff has indicated. I'll note that while this is teed up as a narrow question around partial discounting in a specific fact pattern, I do want to highlight as background that we do seem to get a lot of questions about discounting in general, where people are, evaluating different methods that sort of use discounting in different ways and sort of mixing and matching discounting and not discounting. And so we think this guidance from the staff is helpful in dealing with a broader range of questions. But I mean, it does seem to come up certainly more than I would anticipate. And that's coming from a couple of places. I think people trying to leverage existing practices, whether it's for regulatory reasons or IFRS 9. Maybe they're trying to minimize the allowance for regulatory capital reasons. Maybe they're trying to make the allowance larger because that will result in a larger cumulative effect adjustment, or maybe they're just trying to simplify it. There seems to be a whole host of reasons, but there is this conversation out there about, can we mix and match discounting concepts? And so discounting and non-discounting. And so I think this view from the staff is helpful. To John's point, though, I think the meeting materials, not so much your tee-up, but the meeting materials sort of waded into an area that I was similarly uncomfortable with, as John was, and that was the guidance in the meeting materials about being able to fully discount all inputs in a non-DCF approach, or sort of introducing what sounds to me like a third model of I can fully discount in a non-DCF approach, or I can have a fully discounted, undiscounted approach. Again, didn't hear that in your tee-up, but I did see it in the meeting materials, and I was very much uncomfortable with that. I think the idea was that discounting would be ring-fenced to just the scenario in 30-4, where you're actually discounting cash flows and comparing it to the amortized cost basis. I think if the staff, and I would like the staff to clarify whether it's their intention to sort of introduce this third model of a fully discounted, undiscounted approach, because I think there will be some interest from banks in that. If you go to them and say you can take a loss rate approach or a PD/LGD approach, take the result and just discount that, as long as it's fully discounted, I think there will be some takers on that front. And it just really sort of wasn't, I don't view that as being inconsistent with the standard. I think there are two models, 30-4 and 30-5, and that's certainly the way we've been answering questions to date.
So I'd say that the staff didn't intend to create a third model. It's just if you were to elect to discount a cash flow, so in the example raised, a recovery cash flow, you would be required to discount all expected cash flows in a DCF model.
And then compare it to the amortized cost.
That's
right.
Yeah, and one point of clarification too is that, some people talk about using a PD/LGD model, non-discounted, or using PD/LGD to come up with your cash flows. And then if you use that part, the discounting part would be, once you determine your expected cash flows, discounting all those cash flows. So not the PD/LGD to come into getting your expected cash flows, but once you determine your expected cash flows, however you do it, discounting all of those cash flows back.
Yeah, and I think it is fair, and I wanted to raise this so you can, I would encourage you to be conscious of how you described this in the meeting minutes, but I mean, there are discussions going on about different ways of mechanically applying 30-4 on the discounted cash flow approach. And to me, that's best sort of a preparer-auditor issue where I think preparers might say, hey, we're going to do this operationally a little bit different, but we can show you how that's going to come up with the same outcome as a DCF. That's sort of best handled, I think, as sort of a preparer-auditor issue versus sort of a standard setter issue, in my mind. Okay.
Dan?
Yeah, and on this issue, from our from our perspective, and really coming from folks in our risk organization, what we would prefer to do is to follow what you've highlighted in the paper is the Basel approach for when looking at corporate loans where you have a recovery that oftentimes in a number of markets across the world, you get the recovery well after the default date, and there's a long period of time. And so if you don't discount the value of that recovery from the point in time that you collect it to all the way back to when the loan defaulted, and you just do that on an undiscounted basis, that will have a pretty big impact on your reserves, and it will lower your reserves, and we don't think that it's an appropriate reflection of the economics from a corporate perspective. And so, we weren't envisioning, within the paper and some of the comments made around the table about the potential for abuse here. I think where folks might look to discount losses but not recoveries, for example, I can't even imagine someone trying to do that. And if you would, I would think, the regulators and others would have something to say on that. And maybe I live in a bubble, but that's not, it's not something that we've been focused on. We've just narrowly focused on, this Basel requirement, which we think from a risk, and economics perspective, makes the most sense. Yes, it's helpful from an operational standpoint, so we don't have to create a different model. But when we're trying to do some high-level analysis, if we're not able to do this partial discounting under the Basel requirement, if we go to an undiscounted approach relative to recoveries, that's a chunky number from a reserve standpoint. The reserves will go down. If you go to the other end of the spectrum where you do kind of full discounting, our analysis so far would show that gets you to a similar quantum as doing no discounting. So either of those two, you end up kind of in the same place overall. So it seemed a little bit odd to me that this is, there's a number of places where, we've supported flexibility and embracing kind of current practices that make sense in building CECL reserves and CECL estimates. But this is one area, where we're going to, draw the line, and it didn't really make sense to me from an economic perspective.
Go ahead.
So we have received a number of questions that fall into this bucket, which I would characterize as we do this for regulatory purposes and we'd like to continue to do it because of maybe cost burden. But our view has been, in this case, maybe discounting recoveries might result in a larger allowance, and you might say the regulators would like that. But I think our consistent view has been that whatever methodology is used should fit CECL. And not, because there are a number of questions where we might be making adjustments just because we do something for regulatory purposes. But our view is the CECL models, whatever the banks are doing, should stand alone as fitting the purpose of the accounting standard.
I mean, I guess I struggle with this one conceptually. I mean, the time value of money applies equally to positive cash flows as it does adverse cash flows. So the notion that there's some conceptual purity to only discounting recoveries for a period of time and not even all the way back to the measurement date, I can't get my head around it. I think the concern, that I would have, and I think others would have as well, is that oftentimes when there are choices in GAAP, they often get narrowed, and particularly when it results in a more conservative answer. And I appreciate the comments that Joanne just made, but years from now, will be different people that are interpreting, and we've all seen situations where those choices have been narrowed and they can get narrowed again. And if we can support just discounting recoveries for a portion of the time because it results in a similar result to discounted cash flows, then we point back to Mark's comments, which is that's an auditor preparer issue, that you can find other ways to achieve the same result.
Kevin?
Yeah, and I think just I echo what Dan was saying, and just to go off of what Mario was saying a little bit. I think when you go back to when CECL came out a few years ago, and the notion of you could use a DCF approach, or you could use other type of approaches such as LGD approaches and loss rate approaches and things of that nature. And those other approaches were not necessarily described as an undiscounted approach. It was intentionally written that way to not describe those as an undiscounted approach. There's DCF as one approach. We all know what that is. And then there's these other approaches. And at one point, those other approaches were being described as discounting inherent in the approach. And that seemed to cause a lot of concern around with a lot of constituents. So the idea was, okay, well, let's not characterize those then as being discounting inherent in the approach. We'll just allow those approaches. So now we see how things are starting to get a slippery slope down. And so now all of a sudden, 2 years later, we're at a discounting approach and undiscounted approach. And that's not where the board meant to go with CECL. They characterize those other things as being undiscounted approaches or discounted approaches. They just characterize them to be as other approaches. And these other approaches that we have, such as PD and LGDs, LGDs are determined certain ways. In some situations, those LGDs are determined by discounting proceeds or discounting recoveries when determining what that LGD is. Other cases, they're determined by not discounting those recoveries and those proceeds. So I'm not sure, when you think about the standard itself, as it describes, and you could use these other approaches, well, how granular do we have to get into those other approaches to pick them apart, to pick out the pieces and say, which piece of this has discounting in it, which piece of it doesn't have discounting in it? So that's causing a lot of confusion, and I think to try to go and really pick them apart is gonna create a lot of problems operationally for banks, because some banks, like I said, when they do their LGDs, they discount those proceeds. Other banks, they don't. And I don't know where everything could end up when you start piecing and parsing the other methods that are acceptable within CECL. So.
Yeah.
Yeah, conceptually, with the way it's written, it is hard for me to get there, to Mario's point, but I actually have lots of sympathy to where Dan is coming from. Let's just bring back, and maybe I'm linking too many things together, and similar to the first discussion, Doug has said recoveries can come way, way long after, a charge-off has happened. That's why we have issues in going back to do the vintage for gross charge-off and gross recoveries. And so that shows that the time value of money in terms of recovery could be quite significant. And so that's probably number one, why discounting back is not a bad idea. And second, discounting back to the default or charge-off date, assuming, I know Kevin pointed out some complexity with discounting, non-discounting within certain method, but just assuming the PD, LGD method are not discounted. So essentially what this is trying to do is bring back to the default date, then everyone starting at default date coming back, they're not discounted. So they're actually at the same spot. So there is some merits to the argument in this one. It's hard to fit into the current accounting framework the way it's being described, but it actually has a lot of economic merits behind why this one is actually acceptable from doing your allowance perspective. And then maybe to the earlier point that Mark and John was making on the allowing for all discounting. So Damon, you mentioned it's more taking PD, LGD model at undiscounted and then converting cash flow and discount. But actually to Kevin's point, the inputs go into PD, LGD based on the wording here, you actually can discount them and allow all discount before it even goes to PD, LGD model, which actually could generate very different results from those models. So the way it's wording is actually more encompassing and could result in other practices that you may not anticipate to happen.
Doug?
I also agree with the points made by, I think the other preparers in the room, but I would also suggest that one of the challenges that we've had with the allowance for years and years is basically conflicts between the accounting profession and the regulators. And so to the extent where if it seems like in this particular case, we're creating or potentially creating a conflict between what is from a regulatory standpoint required and what is required from a GAAP standpoint. And from a broader perspective, that has created challenges for the industry. So in those situations where we're consciously creating a potential challenge or potential conflict, I think we need to be aware of that and understand that creates implications in terms of how the preparers respond to that and how they work with that in the future. And to the extent that we have a chance to reset and bring congruent, to the extent possible, bring those congruent with each other, I think we ought to consider that. So if there's a particular regulatory requirement, in this particular case, it's in paragraph 14, the Basel requirement around partial discounting on recoveries or loss given default, then I think we need to be thinking about, can that be accommodated within GAAP so that we don't create that conflict?
Chip?
Wherever the board lands on this issue, to the extent that we go down the path similar to what the staff recommended, the one thing that we wanted to just make sure we're sensitive to is, to the extent that recoveries are coming from collateral, and the fair value of the collateral is obviously the relevant in that calculation. A lot of times the way the fair value of the collateral will be calculated is through a discounted cash flow approach. Like think about like a commercial property where you'll be taking out the future rents and discounting, and that'll help you determine the fair value of the collateral. Just to be careful with whatever language comes out such that we don't, inadvertently impact, fair value of collateral calculations.
Joanne?
Yeah, just to touch on what Doug was saying and then follow up a little bit on my earlier comment. So, there are a lot of different questions we get, like, hey, we've got a forecast that we're using for CCAR. Can we just use that for CECL? We have models that we built for CCAR. Can we just use those for CECL? I think it just, it's a ton of different questions that fall into this bucket of, we do this for regulatory purposes. Can we just do this for CECL? I think of it as, the broad answer to that is the model that firms are putting together for CECL should fit CECL and the GAAP requirement. Now, I think Mario and Mark, what you said about ways, to say we are going to do the CECL standard, and here are the things that we think we can do because they're not materially different or they approximate or whatever. I think those are fair conversations to have, auditor and preparer. But just to that high level question of, should we be adjusting CECL to what we're doing for regulatory purposes because it reduces our burden? I think you would have to say that would not be the target to shoot for. But on any individual issue, you might end up making some approximations that your auditor feels like still fits the spirit of the standard, and the target is still hitting CECL and the principles of CECL.
Mary?
And just with respect to the conflict, I mean, what we're not talking about a gap wrap difference. We're talking about capital regulations, right? So the conflict is how you calculate your risk-weighted assets, which has nothing to do with your gap reporting. So we're not creating differences, and the capital rules are vastly different than the accounting rules in many places, not just in the allowance.
All right. The second TRG submission detailed in Memo 14 relates to the timing of when unrealized losses related to changes in foreign exchange rates from an investment in a foreign currency denominated available for sale or AFS debt security should be recognized in earnings. Prior to update 2016-13, entities were required to consider whether changes in fair value due to changes in foreign exchange rates of foreign currency denominated AFS debt securities resulted in other than temporary impairment, or OTTI. As a consequential amendment to subtopic 320-10 to supersede the OTTI methodology, update 2016-13 amended and superseded the guidance related to the accounting for fair value changes of foreign currency denominated AFS debt securities. The amended guidance in update 2016-13 requires the change in fair value of a foreign currency denominated AFS debt security, excluding the amounts recorded in the allowance for credit losses, to be recorded in other comprehensive income, or OCI. As a result, stakeholders have questioned whether fair value changes due to changes in foreign exchange rates should be recognized in earnings. The staff believes the guidance is clear that unrealized losses related to changes in foreign exchange rates from an investment in a foreign currency denominated AFS debt security are reported in OCI and are recognized in earnings when any of the following events occur: at the maturity of the security, upon the sale of the security, when an entity intends to sell the security, or when the entity is more likely than not required to sell the security before recovery of its amortized cost basis. Some outreach participants noted the amendments in update 2016-13 will result in delayed loss recognition as compared to current practice because unrealized losses related to foreign exchange rates will not be recognized in earnings until one of the previous four criteria are met. The staff understands these views, but believes that the topic is beyond the scope of the credit loss TRG because the topic relates to reporting of changes in fair value related to foreign currency rates rather than credit losses. Furthermore, the staff notes that entities may separately disclose the amounts related to changes in fair value from foreign exchange rates reported in OCI to better inform financial statement users of these amounts. If stakeholders believe the board should consider amending the guidance on reporting of changes in fair value related to foreign exchange rates for foreign currency denominated AFS debt securities, we ask that those stakeholders submit an agenda request. I'll pause for any questions or comments.
Just a quick comment, agree with the staff's analysis, and I personally think it's unfortunate that, now we're going to have FX losses kind of trapped in OCI. I don't think that that's, a good outcome from an accounting standpoint. I know coming through the third quarter, in Argentina, where we adopted the dollar as a functional currency, all of a sudden we had a lot of Argentine government bonds and AFS, and to have a 30+% decline in the currency and not being able to recognize that in P&L until the bonds mature, I personally don't think that that's a good outcome from an accounting standpoint. So, and I know this is not in the right context here, but I personally would be supportive of the board taking on a project to address this. And I think the best solution is to have changes in FX just recorded directly to earnings, like we do under the international standards. And, that way you don't have to go through the burden of hedge accounting and, these other challenges that are there. But I know that's a discussion for a different setting.
Mark?
I agreed with parts of the staff's analysis, so I do think that this risk would be outside of the scope of the ASU because it doesn't relate to credit risk. Understand why it wasn't put on the TRG agenda. I would say, though, since we're given an opportunity to comment, that I did disagree with when amounts should be recognized in or would be recognized in P&L under the codification, absent any amendment. The scope of ASC 450 is pretty clear that the only thing that's scoped out of 450 is credit risk related to these instruments. And so I think it is our view that if there was no other amendment, that 450 would still need to be considered. And again, just thinking more broadly outside the scope of this issue, I mean, we do get questions from time to time about non-credit risk related to in-scope assets. And I think our response in each case is that it would still be picked up in 450. And again, I'd refer you to the scope paragraph in 450, which seems to be written with this topic in mind, that you are only out of 450 with respect to credit risk. So whether it's dispute risk associated with reinsurance receivables or fraud risks or other types of non-credit risks, I think there is still a need to reserve for that under 450.
Graham?
Thanks. Yeah, so we agree with the staff's analysis. Thought it was right. Thought it was beyond first the remit of the TRG, and also it was clear that 326, made this change. And I think one thing that might be helpful in the staff's write-up is because this is a change in practice, it might be helpful to talk about the mechanics of the interaction of kind of how 830 works in this circumstance, right? It's kind of an overlay, because I think there's some folks that aren't used to thinking about it that way. So kind of doing the allowance calculation in the local currency and then overlaying 830 on top of that, I think that might be a helpful thing to do. And I think Mark's point is a good one. It would also be helpful to consider whether if there are interactions with other accounting topics, it would be helpful to say so that people kind of knew where to look. So I think this is a change of practice for people who have foreign currency denominated securities. But overall, I agree with the staff's analysis.
Diane?
Thanks. Just a perspective from the insurance industry. We do obviously have foreign bonds in our AFS bonds in our investment portfolios. A couple things. Number one, absolutely agree that it should be out of the scope of the credit loss standard. We don't want to start, bleeding in other topics into that standard. From a practical perspective, we would look at it very similar to what Mark was describing. We would look at it as a FAS 5, topic 450, and probably at the time that we determine it's probable that it's not going to turn around, that we would take the loss at that point. We wouldn't wait until maturity. So that's generally how many people in the insurance industry would handle it. The other thing I wanted to mention is, just to go to Graham's comment, I think it's also important to think about what kind of an impact it has on an actual credit loss that's taken on a foreign security. So when you take the loss, assuming, in a simple example that you're using a DCF and you're present valuing the expected cash flows, it would seem that you would then do that in the local currency, and any foreign currency, changes would continue to go through OCI for that credit loss. So you would calculate the credit loss based on the original, translation adjustment. So original foreign currency. Otherwise, it gets really confusing as to where it's being placed. And then lastly, if you're not hedging the foreign bond, we would not be supportive of it being reported in income. So, thank you.
Shia, you had you're fine? All right. Chip?
I think we just wanted to say that if there is a view that ASC 450 needs to be applied, that's really important to clarify, because I'm not sure that everybody would have said, all right, I've gone through the rigors of security guidance to calculate a fair value. I've gone through the rigors of the credit guidance to measure the credit loss. And I'm still not done. I need to now go to kind of some overarching kind of, probable loss scenario. If that's required, then I think it's important that that is clarified.
John?
Yeah, I also agree this isn't really something that is part of CECL, but I also agree with the comments. I think we need a little, one, assistance on the ordering of the interaction with foreign currency and the allowance. Two, I do think it's important to clarify what is in the scope of 450. And I know Mark talked about things other than credit, but especially when we get into things like beneficial interests, where you have prepayment risk too, like that's other than credit. We've all had confusion on that. We had to decide up front what contractual cash flows were, I think, in our first TRG meeting. So I think it is important to know what's in 450 and what's not, including FX. And I assume prepayments are not, but if you have an AFS beneficial interest, are we now saying 450 comes into play on taking losses for prepayments?
Yeah, I agree with John. Just to add, I think bringing in 450 every time, we're dealing with financial instruments as sort of like a catch-all. Is there something that we felt bad that we didn't capture in the rest of the model? Is a tough precedent.
I don't know. Maybe I'll say something.
Okay, now, Xiao, go.
Thanks, Shane. No, well, because the way it's written seems FX and credit are dissected very cleanly. Like, if it's credit, it's FX, right? To Dan's point on Argentina, some of the credit probably impacting the FX. So then comes the time and recognition of those losses. If you recognize the credit losses, but the FX change induced by credit, or partially induced by credit, actually was not recognized in P&L, is that too late? 450 may be a way to cover that, but it's probably about the timing, the four listed timing here. In certain circumstances, to me personally, seems it's too little, too late.
Okay. We'll move on to the third and final TRG submission detailed in Memo 14, which considers whether an entity should maintain an allowance for credit losses for beneficial interest in the scope of 325-40 that is classified as trading. Subtopic 32540 is an integrated accounting model that provides interest income and initial and subsequent measurement guidance for certain beneficial interests that are generally low credit quality. Interest income is based on the accretable yield of the beneficial interest and is recognized using the effective yield method. The amount of accretable yield is initially determined as the excess of all expected cash flows to be collected, as estimated at the acquisition date, over the initial investment. After the initial measurement, beneficial interest holders are required to continually update their expectation of cash flows and evaluate if impairment has occurred or if an adjustment is needed to the accretable yield, or both. Update 2016-13 amended the subsequent measurement guidance for beneficial interest in the scope of Topic 32540 and requires entities to account for credit losses on beneficial interest classified as held to maturity or available for sale. Subtopic 32540, as amended, includes subsequent measurement guidance on determining the accretable yield for held to maturity and available for sale beneficial interests. Additionally, Update 2016-13 superseded the guidance that required the same amount of interest income to be recognized regardless of whether the beneficial interest is classified as held to maturity, available for sale, or trading. As a result of these amendments, stakeholders question whether an allowance for credit losses is needed on beneficial interest classified as trading for the purposes of determining the accretable yield. The staff notes that beneficial interests classified as trading are clearly within the scope of subtopic 32540 for interest income recognition. The staff also notes that subtopic 32620 clearly excludes financial assets measured at fair value through net income. As such, the staff believes the guidance is clear that an entity is not required to maintain an allowance for credit losses on beneficial interest classified as trading. The staff also believes that an entity would not be prohibited from determining interest income for beneficial interest classified as trading by applying a similar integrated model that is currently in subtopic 32540 prior to the amendments of the update, except that the measurement guidance would be in accordance with topic 326. Some outreach participants provide an alternative view that beneficial interest classified as trading should be excluded from the scope of subtopic 32540. The staff believes this alternative is beyond the scope of the credit losses TRG and that changing the scope of 32540 would require additional standard setting by the board. The staff recommends that supporters of this alternative should submit an agenda request. I'll pause for any questions or comments.
Graham?
Yeah, thanks. So we, again, agreed with the staff's analysis. We thought the scoping was clear. We do think that the amendments may result in different amounts of interest income being recognized for beneficial interests depending on how they're classified within 320. And that's just an outcome. I think it does, though, raise a broader question. This, again, is beyond this question in the remit of the TRG, but I think there's probably some questions around how you recognize interest income on financial assets measured at full fair value generally, not just beneficial interests, but all trading securities, investment companies, things on the fair, for which the fair value option is elected. And so my sense is that this question is more linked to that than it is to beneficial interest classified as trading. So I guess I'll conclude with that. Thanks.
Okay. Well, that last piece of the discussion was way simpler than I thought it was going to be. Because anytime you start talking about beneficial interests, it can go either way. So,
Take your victory.
yeah, so I'll just stop there on that piece. I did want to go back to the discounting, partial discounting memo, because it struck me as I was listening to everyone give their opinions and valuable feedback that it was left sort of hanging in the air as to exactly what we were going to do or what we should do. And I just want to pose something to the group and at least my take on what I heard. So what I was hearing was that there are differences between capital requirements, reg requirements, and GAAP, and there are some instances where maybe aligning those two makes sense, but not always. I also heard that, the thought was that the board allowed this to be a flexible standard that wasn't meant to be bucketized so bluntly into discounted versus non-discounted. I also heard that this really belongs in the camp of something that auditors and preparers should be able to work out. I also heard that those are valid discussions to have when I want to take a model that was maybe meant for regulatory purposes and convert it to something in CECL, so long as it meets the guidance for CECL. And I can tell you that when the team was thinking about this, what we did not want to do was wade into calling balls and strikes on what input should be discounted, what input should not be discounted, and when or when not partial discounting should be or should not be allowed. Because my own personal view is that was never the intent of the board, which is why we left it as flexible as possible. However, we were asked to weigh in. And so when we weighed in, we wanted to weigh in with sort of a simple, it would appear to us that if you're discounting, you would discount everything, or you would not discount everything. Having said that, in the conversation that I've heard today, my question to the group is this something that can be left to practice and to institutions to come to an agreement as to what makes sense within the models, what people are comfortable with discounting, when, which inputs, and having that granular discussion at the institution level in the spirit of what the board provided as flexibility as to what models to apply. And I ask that because I'd like to come away with either that's okay and we can have those discussions at the institutions and within practice and all come to an agreement on what is most appropriate, or is there a specific ask? Because this, the specific ask that we had, clearly, it was a blunt instrument. And I can tell you that the appetite for calling balls and strikes on, which input is discounted and which not is that's probably not going to happen. So with that as a backdrop, I'll ask that question, is this something that can be left up to practice? And should we back away? Mark?
So I just want to clarify my comments or one of my comments, and then respond to your question. I think on this issue, there's a role for the FASB to play, and then I think there's a role for preparers and auditors to play. And to me, it needs to be clear that there are two methods and two principles behind that method, right? There's a discounted cash flow method where you're discounting all cash flows and comparing to the amortized cost. And then there's, another method which would, where you're allowed to use various methods to come up with your estimate of lifetime expected credit losses undiscounted. If we can make sure that that is clear in the standards, right, that those are the two permissible approaches, then to me, I think the everything else can be left to preparers and auditors, including some of the more detailed discussions about how to operationalize and create and apply methodologies that are consistent with one of those two broad approaches. And so that's sort of how I would delineate sort of where I think the standard setters need to be, and then where you get into the details where I think it should be more of a preparer-auditor discussion. If that's helpful.
The only thing that I would push back on, Mark, and, respond to that is, and I'd be happy to have the institutions jump in because obviously you're way closer to your models than any of us could possibly be, is that I would observe that that's a very simplified approach, that what we have heard from people around the table is that there are instances in those two buckets where there may be discounting. And so the operational complexities that you're talking about that need to be worked out, if we were to say, there is a non-discounted and thou shalt not discount, there's no operational complexity to talk about because you've eliminated that possibility for any of those models. And so you've applied, we in effect will have applied a very blunt instrument for the vast majority of a lot of models other than a discounted cash flow. And if I'm wrong on that, then I'm happy to hear that I'm wrong on that, but I think that bucketizes it into two very simple buckets.
But I think, yeah, I mean, but I think there does need to be a high-level principle established, or else it's going to be very difficult to evaluate the more detailed methodologies and call balls and strikes, right? And so if, you know, that's why I think the 30-5 paragraph needs to be understood as, you know, you're forecasting your lifetime expected credit losses on an undiscounted basis, because ultimately there does need to be a principle for everyone, whether it's preparers, auditors, regulators, to understand whether they're in the bounds of whether they're in the bounds of the standard, and to somehow differentiate from am I complying with the standard to something that is much more difficult to evaluate, which is, does this just make sense, right? If 30-5 is interpreted as just do something that makes sense, it's going to be very difficult for everyone to figure out what's in or out of bounds. But yeah, I mean, I was trying to keep it simple, Shane, because I think that ultimately there needs to be sort of a simple articulation of the principle that then everyone can evaluate their much more complex methodologies against.
Right. Chip?
If I think back to the discussions of where this issue came from, right, and why it was submitted to the TRG, my memory was that there wasn't unilateral agreement amongst preparers and auditors on whether or not the standard was, as Mark said, there's only two approaches, full DCF or discount nothing, or if there was something in between. So I think it would be important to understand the answer to that question. Because if the answer to that question is there's only two approaches, then this discussion between preparer and auditors comes down to one of materiality. And if they're discounting something when the standard wouldn't allow us to discount it, then that's a materiality discussion between preparer and auditor. If the answer is no, there's not just discount everything, discount nothing, but there's something in between, I think that getting that clarity is important, because then perhaps it moves it to a discussion between preparers and auditors and regulators and other stakeholders as to, okay, well, given your fact pattern, what makes sense? You know, so that clarity is it two paths, or are there more than two paths? I think that's important. I think that's something that the FASB can help with.
Kevin?
Yeah, and I think Chip has it right. And does the standard require two paths, or does it require a DCF and then other methods? And then you have to kind of make that call, right? Because, and I think you specifically avoided that when you wrote the standard for the same reasons we had this discussion back 4 years ago as to whether some of these other methods were considered discounting or not discounting. So to leave it up to kind of practice to figure it out, it's going to come down to materiality issue. Because I think the audit firms are going to look at it as black and white. You either discount or you don't. All those other methods are non-discounting methods. Even though the guidance doesn't say that, that's how I think they would be interpreted. And then it becomes back from the preparers to put that fight up, and if they can't fight that fight, then it becomes a materiality issue. So I think there is a role here for the standard setter, and you know, whatever it comes down to be, it comes down to be, and then that's what we abide by. But right now, I don't think there's that clear line between discounting and undiscounted.
Ryan?
Thanks. I'm pretty sympathetic to what Mark's articulating, because I do think, speaking as an auditor, calling balls and strikes is going to be really difficult if we don't know what the strike zone is to some degree. I promise to stop the bad sports analogies, sorry. But I'm also sympathetic to Dan's virtuous articulation of what, you know, we want to make sure that we get the right thing presented. And there might be, this is going to sound contradictory, but hear me out. I don't know that the inclusion of any discounting necessarily means that you're using something other than a DCF approach. And let me try to give a simple example that we heard from some of our clients. So I think most of the time this comes up in the context of a loss given default, where you see, and so I could do my loss given default in two ways. I could say, I take the charge-offs when they happen, and that's my loss given default is the difference, the amount I charge off at the loss date. Or I could say I expect a loss in 2 years, and I'm going to say kind of what are all the cash flows from that point forward that I expect, and I could sort of project what that charge off is going to be. And I think those are two ways of getting to a non-discounted method. Like I think there's, and I'm not the world's greatest PD/LGD person, but that's kind of the thing we've heard back is that it's just two ways of getting to exactly the same thing. And if that LGD is no different than if we just used our charge-off number, what's the difference? Maybe I guess the summary point is that just at the Chip's point about can we think about the fair value of collateral, does that kick us out? I think there are ways to look at cash flows that don't result in a partial discounting method. And that might take some time to think through and work through, but I think it would be important to articulate that in a principle so that we could call balls and strikes.
Kevin?
Yeah, thanks, Shane. I think I'm just probably piling on here, but I think, we believe that the principle should be specified in the standard, whether it's allowed or not, to be clear. And then those discussions that happen between the auditor and their client can certainly happen, but that materiality discussion is always around how far off the principle you're getting, and until you know what the principle is, you really can't make that judgment. So we believe the standard said it should do something here.
Dan?
Yeah, it's a good question. I think the point that I was more narrowly focused on, which was from an economic and risk perspective, it makes sense to us to be able to discount recoveries back to the default date, which is consistent with Basel, but it's really, we think, the best representation of your true losses, and so it has economic merit. But if the board and the staff does not do anything in this space, we will not be permitted to do that. And it's pretty clear to us, based on discussions with the big accounting firms, with interpretive guidance that's out there. So, and that's just focusing more narrowly on that aspect, but that's kind of feedback to your question. I might also note, I understand that some of the loss rates, perhaps, that smaller banks purchase today do have some element of discounting in there. So, that would need to be, to the extent that exists out there, that would need to be addressed, depending which way we go.
Okay. I'll ask the team, any questions? Any other questions that you guys have? Oh, sorry. Wes?
Let me just add a couple of observations. I think the discounting discussion has been valuable. I did want to pull on just a couple of points. One, Joanne made a very good point about the role of regulatory practices distinct from investor reporting practices. And so without repeating it, I simply associate myself with Joanne's points. Two, in terms of the staff discussion regarding the potential for bias and manipulation, I would refer us back to the existing practices regarding procedural discipline, the role of controls, which is embedded certainly in SEC guidance as well as regulatory guidance from the banking agencies. I do think that's an important safeguard. And then I'll end with a third point, that disclosure regarding the methods, the assumptions, and the approaches has been an important building block for the investor package associated with the application of the standard. Those 3 points, I think, move in the direction perhaps of applying the standard in a way that avoids materiality decisions. I don't think we should be standard setting or discussing a standard with materiality calls in mind. But I also don't believe that the standard can be so rigid as to preclude a number of operational approaches to developing management's best estimate of expected losses.
Thanks, Wes. Sure. So, first off, is that it? Those final comments were very helpful. I think that gives us a way to move forward, engage with the board, and then so we have a plan as opposed to just hanging. If there are no other questions, we'll take a quick 10-minute break and then come back and start the next one. Thanks. Go ahead and get started with contractual term extensions and measurement inputs, and Damon's going to lead this.
All right. So now we're through the easy topics. We'll start with our first official topic. Memo 15 discusses two related issues with respect to the contractual term over which an entity measures expected credit losses on its financial assets. Although each issue was submitted independently of the other, the staff believes that the issues have interdependencies and should be discussed together. The two issues are, Issue 1, whether certain extensions should be considered when determining the contractual term of a financial asset, and Issue 2, whether an entity is precluded from considering measurement inputs beyond the contractual term when estimating expected credit losses. I will now present each issue separately. Issue 1, extensions. Stakeholders questioned if considering extensions when determining the contractual term in certain situations would more closely align with the board's overall intent for Update 2016-13, even though paragraph 326.20.30-6 directs that an entity shall not extend the contractual term for expected extensions, renewals, and modifications. The following are 4 scenarios to consider. Scenario A. The financial instrument does not have explicit extension options. However, the lender may have a past practice of renewing or extending the term of the loan. Scenario B. The financial instrument contains a contractual extension option that provides the borrower a unilateral right to extend the term of the lending arrangement. Scenario C. The financial instrument contains a contractual extension option that provides the borrower with a conditional right to extend the term of the lending arrangement. The conditional right may or may not be within the control of the borrower. Scenario D. The financial instrument contains a contractual extension option that provides the lender with the right to extend the life of the lending relationship. In outreach prior to the TRG, the staff observed that nearly all outreach participants expressed that the extensions described in scenarios A and D should not be considered when determining a contractual term of a lending arrangement. The staff agrees with these views and believes that considering extensions in these situations would not be permitted. With respect to scenario A, the staff believes the use of the phrase contractual term was intended to only include conditions in the current legal terms of the contractual arrangement between the borrower and the lender. Therefore, non-contractual extension options should not be considered in the contractual term. With respect to scenario D, the lender has complete control over the extension option. As a result, the staff believes that these extension options do not represent a present obligation to extend credit and therefore should not be considered when determining the contractual term. With regards to the extensions described in scenarios B and C, stakeholders expressed mixed views on whether these extensions should be considered in the contractual term. Most outreach participants supported considering the borrower-controlled unilateral extensions described in scenario B when determining the contractual term of the loan. However, some outreach participants opposed considering these extensions due to their interpretation of the guidance in paragraph 326-20-30-6. The staff believes the extension options described in scenario B should be considered when determining the contractual term. The staff notes that the contractual nature of these extension options and the borrower's complete control over the exercise of the extension options indicate that the lender has a present legal obligation to extend credit to the borrower. Furthermore, the staff believes that these extension options are economically similar to a loan with a maturity date that includes the extension period but can be prepaid at a point the extension becomes exercisable. The staff notes that there is a distinction between a contractual extension option explicitly provided during the initial underwriting, which is scenario B, and a non-contractual extension option granted after the initial underwriting. While the guidance requires the former to be considered in the contractual term, the guidance explicitly precludes the latter on the basis of the guidance about expected extensions. The staff notes that many outreach participants explained that loans providing the borrower the unilateral right to an extension without any contingent features or any subsequent underwriting are rarely issued in the marketplace. If these types of loans are not commonly underwritten, the staff questions whether the issue would be pervasive enough to warrant further clarification in the guidance. With respect to scenario C, proponents of considering these types of extensions when determining the contractual term noted that the lender may be obligated to provide funding if the contractual conditions are satisfied. Many stakeholders expressed the view that any loan extension outside the lender's control should be considered in the contractual term. These stakeholders mentioned that lenders should estimate the probability that the extension options would be exercised when determining the contractual term. Opponents of considering the extensions options described in scenario C noted that these extensions do not represent a current obligation to extend credit, since certain conditions have to be met before the borrower can receive the extension. These stakeholders also mention that contingent extension options may implicitly represent a new underwriting and therefore should be treated as a separate lending relationship for purposes of determining the contractual term. Some stakeholders question whether Update 2016-13 was intended to require entities to perform complex probability assessments about whether contractual conditions included in extension options would be satisfied in a future period, and then if those contractual conditions were met, another probability assessment about whether the borrower would exercise the extension option. Stakeholders also expressed concerns about the operability of considering the extensions described in scenario C, including whether data related to these extensions are currently captured in risk management and accounting systems. The staff acknowledges that there are many arguments for and against considering the extensions described in scenario C in the contractual term. Rather than provide a recommendation, the staff seeks to gather additional feedback from the TRG members with respect to the issue, including the operational concerns raised by some stakeholders. So the question for the TRG with respect to issue 1, R1, does the TRG agree with the staff's analysis with regards to scenarios A, B, and D, meaning A and D would be out, B would be in, but maybe further discussion on how pervasive those products are in the marketplace. And question 2, does the TRG have feedback on whether the extensions described in scenario C should be considered in the contractual term of a financial asset when estimating credit losses? And then finally, if TRG members believe that extensions in scenario C should be considered in the contractual term, would the additional complexities in evaluating the likelihood of both that the pre-specified conditions are met, and then if they are met, the probability that the borrower would actually exercise the option to the loan justify the benefits? So at that point, I'll turn it over to the TRG for discussion.
Yeah, thanks, Shane. All right. Yeah, thanks. So we agree with the staff's analysis and conclusion on scenarios A and D that you wouldn't consider those. And we also agree with your conclusion on scenario B that you would consider that. And if you agree that scenario B should be considered, we find it hard to defend why scenario C wouldn't also need to be considered. And we would, our view is something that's not in the lender's control, where the lender can sort of walk away and cancel the loan agreement, should be considered because there's increased credit risk, and that should be considered in the measurement of the allowance. With respect to scenario C, we would agree that capturing the likelihood of the contingent event occurring and also the borrower's exercise of their option should be considered in the measurement.
Thank you. Doug?
I think I would agree with the staff's assessment on A and D. as well as B. I think all those make sense in the I guess, event that you don't have anything that, on A and D, you don't have anything that's really a contractual commitment, then it shouldn't be included. On B, you certainly do have a contractual commitment that the lender doesn't have control over. I would disagree, I guess, with the comments on C. I would think C is something that should not be included because I think operationally it's going to be very challenging to do the probability analysis, and not only do you have to do that probability analysis on each individual contract on a go-forward basis, but then you have to track and validate and adjust that probability analysis, and I just don't see a lot of institutions being able to do that effectively on a go-forward basis. But also adding to that, I wonder if it's really going to have a material impact on your allowance calculation, because if you make the assumption that those conditions are met so that the contract is extended at that point in time, then you're probably making the assumption that the borrower is in very good standing to be able to meet those financial covenants or conditions or whatever the case may be in those contracts. And so is it going to extend or increase the potential credit loss that you're estimating in the analysis in the first place? And I would say that in most cases, it's probably not going to increase that potential credit loss or that lifetime credit loss substantially, because you essentially make those conditions such that the borrower is probably in pretty good shape at the time that that extension is made.
Jeff?
Yeah, so I want to talk about the way that we were thinking about it, and if I understood Kevin correctly, I think we agreed basically with his points. And we came down to, I think, what is a very simple principle. If the borrower, if the lender controls, then you don't extend, but if the lender doesn't have control, you would extend. So, we saw scenario A and D as really not that different from one another, that, I think the lender always has the option to extend a loan, whether it's written in a contract or not there. So, we would have concerns with A and D if we saw that without underwriting. I think we would see that as a safety and soundness issue. We also thought it might be a good idea to try and define contractual term. And our initial stab at that was to consider whether the lender is contractually exposed to credit risk, and it's not within their control to end their exposure to credit risk. The point about scenario B being rare, and maybe we don't need to address it because it's not pervasive, I think that we still should make it clear on that point, because I think if it wasn't clear, it could be very attractive under CECL as a way to get a shorter life. Even though we don't see it today, you don't need it. People might say, oh, this is a way I can really make a 4-year loan and call it, a 1-year loan with these unilateral rights to extend and not have to treat it as a 4-year loan. And lastly, on scenario C, so we would say for B and C, you would extend in those scenarios. And I understand you have to consider, it might be complex, but to me, it seems like it's kind of the flip side of the coin for prepayments. So you have to figure out whether you're going to have prepayments. You can make a long-term loan and think about prepayments, or you can make a shorter-term loan and think about extensions. I think it's also very similar to commitments to lend. I think you have to think about what's the likelihood of the commitment being exercised and what amount would be drawn. So I understand the operational complexity. Obviously, if it's not material, then I don't think you have to worry about it so much. But, I think if a bank's engaging in those products, they really should have the ability to assess the associated risk that they've undertaken and their impact on their expected credit losses.
Okay, so John and Graham, you guys put your cards up at one I was looking over there, so I'll let you decide.
I'm happy to go. I'm happy to go if you guys.
How am I supposed to speak
on the
right
inside?
God, turn a hose on them. So we agree with the staff on scenarios A, B, and D. For scenario C, and I think this is maybe consistent with what we've been saying for disclosures, vintage disclosure discussion that we're going to have later, but I don't quite understand it's a new underwriting. If you built this into the terms up front, we view the contractual life to be everything within the contract at the time that you originated the loan or established the relationship. So
if there are extension periods, contingent or not, that you can't undo, then we view the contractual life as including that extension period. And you're not really making another credit decision at that time. You've already pre-wired the conditions that would allow them to extend. That decision was made up front when you entered into the contract. So we believe that is consistent with the contractual life. For those that would say no to C, I would wonder then, that's too difficult to model in whether these get extended or not because of the contingencies. Are we talking about then that the life should be assuming no extension, or that the life should automatically include the extension? And I do kind of agree that these same sorts of analyses are happening for a lot of commercial lines of credit. They have material adverse change clauses. They have these sorts of contingencies in them that still would factor into whether they can be drawn. But the lending institutions can't unilaterally back out of them, and so they have to make these sorts of judgments already.
Graham, and I won't comment on whether you're beautiful or not, but
Please. Save me, Shane. Yeah, so so thanks for that. We agree again with the staff's analysis A, B, and D. We largely agree with the staff's analysis on C, but thought we'd point out just a couple of maybe added intricacies that might be worth considering. So first of all, the way we understand these options is that they are generally borrower-specific options. And so in that regard, we think of them as no different than, say, a covenant violation. Effectively, there's no difference between a borrower meeting a condition or violating a covenant. They seem like two sides of the same coin. And so as long as those conditions, were they met, were in the control of the borrower to extend, we think that they should be considered. If it was somehow a market condition, and we asked our clients and didn't get much feedback that those things are out there, but we would draw a distinction between, like, if the S&P hits a certain level, then you can extend. Well, that's probably different. That's probably different. And echo John's points and Jeff's on, it's easy for the auditor to say we appreciate the operational difficulty, but this doesn't seem like a different analysis than undrawn lines of credit or prepayments. So I think we struggled to see not allowing it on that basis.
Bob?
I just wanted to agree with much of what Jeff said.
But not all?
No, I was just, maybe I didn't say that as well as I should have. But to go to Graham's point, the C scenario, and maybe this is what you were getting at, says the right may or may not be within the control of the borrower. And I think that goes back to what Jeff was saying too. So you almost have to, I would think you almost have to distinguish between the two, the ones that are within the control of the borrower. It seems like most people say, yeah, you consider that. The ones that may or may not be, maybe when but if it's not within the control of the borrower, that seems like it's in the control of the lender and goes back to your general rule. So I guess the question from an operational standpoint, my understanding is these are primarily for commercial type loan, not on retail credits and so forth. So it's probably a smaller population in the entire portfolio. Is there a different thought process if this is being done on a pool basis, whereas as opposed to cases where the allowance is being done on an individual loan because it doesn't share similar risk characteristics, and then just the operational issues? And I don't know, I looked to the community banks to suggest how challenging it would be for them, particularly if they're doing this on a pool basis. They have to evaluate probabilities from period to period. That could change from period to period. That does present operational concerns. What's the most efficient way for them to, if this is part of the standard, to implement it in a way that isn't so prohibitively difficult that they change their lending practices just to avoid an accounting outcome? So that'd be a concern for small banks.
Dan?
We agreed with the staff's conclusions relative to the scenarios A, D, and B. We also think scenario C really should be lumped with B, should be treated the same. Under GAAP today, we do provide loan loss reserves on scenarios B and C. So we, that's how we're currently treating under current GAAP. And so we don't, because we view scenario C not to be within our control as a lender, there is credit exposure there that needs to be measured and reserved for. I guess, from an operational standpoint, I don't know if there's latitude to, if it's too complex, too difficult to come up with the probabilities, just to assume 100%, and that I think would address the operational concerns from our perspective.
Yeah.
Yeah, that's the same thing I was just thinking. It was require it 100%, but then apply your prepayment notion in there, because a lot of them in the pool situation, because a lot of these are going to occur in the pool situation, you usually have a good idea of what your prepayments are within a pool, so just require that entire term, apply your prepayment situations to those, and it should fall out, pretty good in that situation. I think that would be easier, I think, from an operations perspective than trying to figure out, okay, what's the probability of the condition being met, and then what's the probability of them exercising after that. You could take all that off the table by just requiring the entire term and then just backing it out through prepayments, potentially.
Mark?
Agree with the staff's analysis on A, B, and D, certainly. And I would also really commend the staff for putting this issue on the agenda. I mean, I think especially since this issue went on the agenda, I've certainly gotten more of an appreciation for the fact that this is going to be a little bit of a burdensome thing to address. And so I think talking about it in this meeting, giving this issue a little bit more exposure so that if companies are behind on addressing, scenario C, they can begin to address it this far out from implementation. So I think having this discussion is really valuable. But because C has the potential to be burdensome for some entities, the only way to really reduce the burden would be to, either violate a basic concept in the standard, which is all of your contractual credit exposures are subject to CECL, right? That would be, we could just take scenario C out, but then that would seem to sort of violate that basic principle. And then also, it would, I think, create a pretty large structuring opportunity as well, right? You could take a longer term loan and turn it into a shorter term loan with some sort of contingency, right? And there's no discussion of how substantive the contingency or whatever. If you throw C out, then you can put any contingency in there, and now you're reserving for the shorter contractual term. And so I think for those reasons and reasons that have already been cited, I think, scenario C needs to be within the scope of the standard. I also wanted to point out that, if we're concerned about whether credit exposure should be reserved for if the credit exposure is still dependent on the outcome of events or conditions, I mean, I would refer you to the consequential amendments that you made to 460 around things like standby letters of credit, where standby letters of credit are already credit exposures that are dependent on the occurrence of certain events or conditions, and that it was obviously pulled into CECL through some pretty direct amendments to 460. So I think that part of the question, in my mind, has already been asked and answered, and understand that there are some degrees of difference, certainly between a standby letter of credit and what we're talking about here, but there's also some similarities when it comes to kind of the basic question that I think the staff was posing. And then the last thing is I really do think factoring in the likelihood of exercise into the measurement is really the right answer from a financial reporting perspective. Extension options that are very unlikely to get exercised should have minimal impact on the allowance. Extension options that are very likely of being exercised should have a much more significant impact on the allowance. That all seems to make sense. And to the extent that there are uniform provisions being used, I would hope that this is already in the historical loss experience, right? So if a company originates 5-year loans with a 2-year extension option, and that extension option is typically exercised, I would think that would already kind of be in the historical loss experience with respect to those entities. And I just want to put in that reminder about using historical loss experience, because that should mitigate at least some complexity in some circumstances, because you have that as your starting point, and hopefully that included some of these types of provisions in the past.
Helen?
So just want to agree with the staff on A, B, and D, and as well, I would include C, where the lender is obligated to extend the credit. And my reason is, I think it also aligns nicely with the IFRS. So as an IFRS reporter with US filing obligations, trying to minimize as many differences as you can there. And under IFRS, you need to, consider the contractual period for I think it's the wording very similar to what Jeff used for when you're exposed to credit risk. So would support having C in there.
Brett?
Yeah, I just thought to reinforce things. I think that from a user standpoint, we don't have any insight into the contractual issues. I do worry, especially in the non-regulated sector, that if this B isn't clarified, that we could get some abuses. So I think clarifying that's going to be important. And I kind of just think the idea of including C and B together makes a lot of sense. And really because you can deal with C with probability of default, it feels like. I mean, if you've got all these protections, the expected loss is going to be very low. It seems like a cleaner way to do it than try to carve it out.
Okay. Mario?
I was really just going to reiterate a lot of the points that were made. I think conceptually it's really hard to argue that C shouldn't be lumped with B. But I think it's also important to understand that I don't think it's something that institutions are prepared to do yet. Because I think today, when we're looking at the commercial loan portfolios, we're looking at borrower history. So we're not looking at the specific terms and conditions of the individual loans themselves. And similar to the discussion we had earlier on recoveries and charge-off, that data exists. It's in the loan system, but you can't extract it, right? So you can't pull a feed from your system of record and say, here are all the different flavors of my terms and conditions. So so again, not looking for sympathy, just looking for understanding that there will be an effort to pull all that data together, to understand it, to evaluate it, and then to determine what the probability of extension is. So I tend to lean towards where Kevin and Dan are, where more of an on-off switch is better, to say that if you've got certain covenants, like a debt service coverage ratio, and they're meeting it at the measurement date, assume 100% extension, versus, well, what's the likelihood that they won't meet the covenant, or that they will meet the covenant, as on the opposite side, and then some portion of the amount is extended. I think that's a much more complex analysis. And as it relates to prepayments, currently most of us don't have prepayment data for contractual for commercial loans. And we use other data that's akin to prepayment data, but it's not prepayment data.
Doug?
Yeah, I agree. I think it's conceptually and theoretically hard to exclude C. I just think operationally it's going to be challenging without some kind of on-off switch. So I agree with Kevin's thoughts in that respect. And I hearken back to the discussion on we have to do it for unfunded commitments at this point in time. And I would venture to say there are many, many, many community banks and credit unions that struggle with how they create an allowance for loan loss on unfunded commitments that makes any reasonable or rational sense whatsoever. So I think this is somewhat the same issue. So without that kind of on-off switch, it's going to be rolling into, kind of that same kind of challenge around what do you do from an allowance for loan loss perspective on unfunded commitments. So I think that makes sense.
Sydney?
Yeah, I also agree with C. You've got a separate unit of account. You have to include it in my mind. One thing that I struggle with, and maybe this would be an opportunity to clarify, is that to me, there's a real conflict between 30-6 and 30-11. And one thing that I found helpful is in the staff paper where you drew a distinction about, well, this is included as part of the initial underwriting. So would there be an opportunity to either, I think it was in either paragraph 21 or 24, to bring in that concept? That way you don't have the conflict between, at least the way I read it, 30-6, that says thou shalt not ever extend.
Chia?
Yeah, I'm not going to repeat what everyone said. It's just more on the operational burden related to C. Maybe, the wording can be a little bit more liberal to allow for certain practical expedient to be used. So, if you look at on the credit side for extension, but, you do have to manage a duration for your assets and liability, right? So you have to assume certain duration for those assets as well, considering some of the extension in there when you manage an interest rate risk. So there are things you can potentially approximate. Going back to what Kevin said, prepayment or other things when you estimate duration on your assets liability management. So you can probably take that as a proxy or approximation for what you can do for the extension duration.
Okay, so just to summarize kind of what I heard from the different comments, it seems like most stakeholders would say B and C are in, A and D would be out, and there would need to be clarification of that. I did hear, some people believe that you should have to do the probability analysis. Some stakeholders believe, whether it's concerns for small banks, large banks with data, also how this would be operational with a pool basis. Should it be required that you would assume 100% and then look at prepayment? So you basically you extend your contractual term and then look to prepayment from there. So it seems to be two different views in that camp. Anything else that I'm missing? Okay. Moving on to issue 2 with this paper is measuring inputs. Stakeholders also question whether an entity is precluded from considering measurement inputs beyond the contractual term when estimating expected credit losses. The TRG submission provided an example of a situation in which some stakeholders view forecasting beyond the contractual term to be appropriate. The example describes a lender that provides a 1-year term to an entity working on a real estate project expected to take 3 years to complete. The project assets serve as collateral to the loan, although the borrower and lender may expect to perpetually refinance the loan until the project is complete. The contract does not include an explicit extension option. Given the interrelated nature of the financing arrangement and the construction project, stakeholders question whether the probability of borrower default should be considered beyond the 1-year maturity date when forecasting expected credit losses. As an aside, the staff notes that issue 2 only addresses which measurement inputs can be considered when determining expected credit losses and does not contemplate any adjustments to the contractual term of the financial asset. The contractual term for the fact pattern described in issue 2 would be 1 year, consistent with the staff's conclusion with respect to non-contractual extensions in scenario A of issue 1 that we all just said was out. The staff believes that considering information beyond the contractual term of the financial assets does not in and of itself result in extension of the contractual term. In the submission, stakeholders presented the following 3 views on the topic. View A, entities should consider only the probability of borrower default within the contractual term of the loan. View B would say entities should consider the probability of default throughout the life of the project, even if the project extends beyond the contractual term of the loan. View C would say entities should consider only the probability of borrower default beyond the contractual term of the loan as it relates to determining the probability of the borrower being able to refinance with another lender at market terms. During outreach before the TRG meeting, stakeholders expressed mixed views, with some stakeholders supporting each of the views described previously. Additional details on the outreach feedback can be found in Memo 15. The staff notes that this issue focuses on the types of inputs that can be used when measuring the allowance for credit losses, namely the probability of borrower default. The staff notes that Update 2016-13 does not require nor preclude specific inputs that may be used in determining the estimate for credit losses. As a result, the staff believes it was not the board's intent to provide explicit guidance on what input should or should not be used when measuring the allowance for credit losses within the contractual term. Based on that analysis, the staff has decided not to support a particular view on the fact pattern presented. but rather believes that entities should apply judgment according to their unique facts and circumstances. The staff notes that the guidelines established in paragraphs 326, 20-30-7 through 30-9, rolls right off the tongue, would apply to all inputs that an entity decides to use for estimating the allowance for credit losses. Based on this guidance, the staff believes that entities should consider available information that is relevant for assessing the collectability of cash flows during the contractual term, which may include information from periods beyond the contractual term. The question for the TRG with respect to this issue is, does the TRG have feedback on the staff's interpretation of issue 2? I'll now turn it over to the TRG to discuss.
Kevin?
Yeah, I found the write-up to be a bit confusing, because I think both issues are in there, but just, it didn't seem to come together nicely. So there's two things, right? There's the ability to use information about future events to help you inform your losses within the contract period. And then there's also the issue of the ability to project losses beyond the contract period, right? I think the views address the latter, but I think what we should be concerned about is the former, and I think the staff answered the former. And they answered it in a way I think is the way it should be answered, that yes, you can consider those future events to inform the losses that you have within your contractual period.
Jeff?
So a couple of points. I think, we basically agreed with the statement in paragraph 39 of the paper that the project would be a construction project would be underwritten for the entire construction period. So we think that, the primary source of repayment would be from the sale or operation of the project when it's completed after 3 years. So, I think we were generally okay with the views. The view A, though, I think we weren't sure how, we had two different schools of thought of how one might interpret that. So I think the loss given default at the end of year one would be enormously high. What we weren't clear on was what the probability of default would be. So one view was, well, we always, our historical loss experience shows we generally do refinance these, and so there's very little default at the end of year one. Or would you say, if they were required to repay it at the end of year one, there would probably be a very high likelihood of default. So it was unclear to us how to think about view A from a PD perspective.
Yeah.
And then the last point was just really about, we weren't sure if this was just a narrow dealing with construction projects, or if it was meant more broadly. I think we would think about it more broadly on all kinds of, short-term lending arrangements that have some kind of longer-term.
Yeah. And I think the way we viewed view A, and if anyone disagrees, please speak up, but basically with view A, you would consider your PD/LGD all within the contractual term, and like you said, it's probably going to be a pretty large loss. And if you open up that concept, if you look at, well, we're going to get to recoveries, so can you consider recoveries that happen outside the contractual term? This would seem to constrain that by just looking at information within the contractual term, which, didn't seem like that was going to align with, other discussions we're going to have. So we looked at it as a pretty strict view A is contractual term. I determine my PD and LGD based on information within that contractual term.
Thanks for that feedback. I think, some of us initially thought, ooh, that'd be the least amount, but it sounds like you're saying you think it'd be the largest amount.
Yeah.
Bob?
I just wanted to go a little further than Jeff did on sort of the scope of this. I think we agree, I agree in the conclusion that Damon, you mentioned, which is mentioned in paragraph 47 about the information. What is short term? This is a nice, clean example, and it's not an unusual example, but as Jeff was suggesting, you may have other loans that were underwritten and may have maybe a 3-year, say a commercial real estate loan, 3 years, amortization out much longer. When it's underwritten, there's no expectation that the loan's going to be paid off in 3 years. It will be these types of scenarios, refinanced internally, refinanced externally, or if things are really going bad, you end up with a foreclosure situation. So in that scenario, there's never the expectation that's going to be paid at the end of the original term. So to ignore information about what would happen after that seems like a correct answer. But if we're going to go in this direction, I think there needs to be some explanation of what the true scope of this is. Is it really intended to be as narrow as the specific example with a project, or does it apply more broadly to a variety of situations where the purpose of the financing and the repayment terms and what the exit strategy is doesn't really match with the literal contractual term of the loan?
No, it's a good point, and I think really, sorry, my mic's not on. And really, what we're pointing to is, paragraph 326-20-30-7, which says, you can look at basically all information, including reasonable and supportable forecast information, to come up with what your loss is going to be in the contractual term. But, basically, we feel like contractual term, there's a boundary, but for the information, you wouldn't have that same boundary.
Gia?
I don't disagree with the conclusion, but maybe to Jeff's point on the LGD. So most of those loans, construction loans, and I didn't verify this. I probably should go back to my credit folks. When you extend the terms, it's the same loan number, right? And you go all the way till the end. So the data you're collecting on losses is for the entire duration. It's not just for that short-term loans. So then the question is, how do you really dissect the losses for that short-term period versus, the data collected is for the entire life? I think that conflict is a little bit hard to resolve.
Yeah, and one question, that we could ask all of you is, when you're doing a construction loan, is this a scenario that's out there a lot where you would just write a 1-year loan with no extension, even though you're writing it for a 3-year project, and basically there's no extension option? Obviously it would be in the lender's best interest to extend, but we also wanted to get a sense of how pervasive this fact scenario is as well.
Yeah, excuse me, from our
Hey, this is Tim. Can I jump in here?
Yes.
Yeah. In the community banking world, it's very uncommon to have a structure where you have a project is going to take 3 years and you're going to finance the first year. There's not that misalignment. And then based on the information we have, we'd be able to make a much better gauge on the kind of losses that we might experience, because we have a 3-year project here we're into, and if it's not going well, we're going to know that. But to force ourselves into a situation where there's misalignment, we don't typically see that. Just so from our standpoint, I think it's a different question, and the feedback would be, I think this is not a common thing we would see in the community banking world.
Doug?
I think then it gets back to the scope question that was already raised, because I think that may be the situation in a construction loan that's a 1 to 3 there. But how do you prevent this from being expanded? Because I think what is really common is we do a lot of commercial real estate loans where we have a 5-year maturity and a 15-year or a 30-year AM. And is that conceptually different than this situation? And in a 5-year maturity, what happens is, if you're not considering inputs, can't consider inputs after the fact, if you get to that 5-year point and the borrower can't repay, or you don't want to extend that loan, then you get into a collection and recovery situation, which is going to happen after the contractual term. And so the recovery is going to come in at some point after the contractual term. So if you aren't considering those inputs after the contractual term, then you're probably not getting a realistic view of what the ultimate, estimated credit loss is.
Okay, that's helpful.
Dan?
I was just responding to the question. The fact pattern in the paper, we don't have that fact pattern either at Citi. But I think what Doug describes, I would assume we do, and I haven't studied that in detail. And so I think, the scope of what we're applying here, I think, does get important. Is it, on this fact pattern, or is it much broader, along the lines of, I think, what Bob was highlighting?
No, that's helpful. And even in situations, as you described, I think view A obviously is in the contractual term. View B, I guess even if you wrote a 3-year loan just for the scope of the project, it would seem that, you know, the boundary wouldn't just stop at the project as well. You could consider information beyond that as well. So I guess with the different views out there, is there anyone that was strongly in B and just would kind of want to hear the pros and cons of that? And then also, I know a lot of people, when we did outreach, this was very split, A, B, and C. So definitely want to hear from people that were in the B camp and C camp of, you know, kind of what the thoughts are behind that.
Mark?
Bad timing, because I don't think I'm going to respond directly to your question, Damon, but
Thanks, Mark.
maybe we get some more cards coming up afterwards. I mean, I just want to make a comment that I think it's hard to limit this issue just to this specific fact pattern, because I think this will come up anytime you have a loan where repayment at maturity is dependent on refinancing, either with you or somebody else. And, you know, in the past, the entity has refinanced and not necessarily, so their historical loss experience won't, if they've refinanced with the borrower, their historical experience won't pick up situations where there was a credit loss because they were unable to get financing with a third party. So I do think it's hard to restrict this. I think it's similarly hard, though, I've found to write guidance in this area about exactly what companies should be doing to sort of come up with an appropriate estimate of credit losses, because there are unique aspects to how an entity underwrites or how an entity has developed their historical loss experience that kind of give dealing with this issue a little bit of an entity-specific flavor in a lot of cases, and it makes it difficult to generalize, other than, I think, just raising the awareness that there is this thought process that needs to be gone through for lending relationships where in the past they've just one lender has just rolled it from one maturity to the next, and going through this thought process to say, how do I estimate credit losses to acknowledge that possibility that if they weren't refinancing with me, they may not be able to get financing elsewhere.
Right. And so definitely understand there's different fact patterns out there, and outside, it seems like outside the scope of what was submitted. In our paper, we point to, as I said before, 30-7. Is the ask to, because basically we point there and say you can consider all information, you know, what this paragraph says. Is there other guidance that people are asking for, or is this something that practice is going to be able to figure out based off the guidance that's already in CECL?
I'm going to set Graham up. I don't know if you're going to respond to him, but Graham, all right.
Extroverted. So thanks. Yeah, so Damon, I think I've actually viewed this as not a discussion that applies to a narrow fact pattern of loans, but just a further articulation of paragraph 30-7. And I think, to me, this discussion today has been helpful in providing context, and I don't know that there needs to be incremental amendments. But I do think the point that Kevin raised from the get-go is probably important to capture in the minutes, which was, I think you can consider whatever is relevant in determining the risk of repayment pursuant to your contractual terms, considering the extension as we talked about in the first question. So I think that's a pretty reasonable principle to articulate, and I think, you know, Mark's point's well made. How that works out is going to be impossible to write down in a standard. And I think if we have a clear articulation of the principle, you know, we can sort through that.
Jeff, Joanne, I'm not sure who was first.
Yeah, I wanted to respond to the question about like who might be a proponent of UB. So we're a proponent of UB in particular because we think the project would have been underwritten for a 3-year period for safe and sound, you know, from a safe and sound practice perspective. And it's the true exit strategy. You know, the true exit strategy is at the end of year 3. And then at the end of year 1, it's really undesirable for everyone. You know, the borrower doesn't really want to have to go looking for a loan just 1 year into a 3-year project, and then the lender doesn't really want to have the risk of, I guess, non-payment, because the exit strategy, the borrower cannot actually pay. So we look at that as really view B would probably match up with what the true risk management is and underwriting of it. just to the point on the question about would additional guidance be helpful? I do think, there does tend to be, we have so many conversations on topics that it feels like once we talk about it, maybe we don't need any additional guidance, but and we might know to look for the minutes, but I do feel like this particular, because the contractual life is such a huge part of the guidance and how we talk about like not considering things beyond the contractual life, I feel like it would be helpful to have something more, I would say guidance or standard setting, but really could, it's possible it could be the minutes, but I do feel like this is one of those things where most preparers and maybe auditors that aren't plugged in, would be very important in the just basic operation of the standard.
Jeff?
So I appreciated, Tim and Doug's perspective about, how common this is. I'm not sure it matters how common it is because like we're talking about, it's probably got a broader scope than this, but I just wanted to comment that it's not totally unheard of. I mean, we have seen these kinds of things, and I think they really didn't even view the maturity as maturity. They viewed it as more a repricing opportunity and an opportunity to take the collateral if things weren't going well. So it really was viewed as a 3-year loan with kind of pricing and credit risk resets as interim periods, but it was structured legally as a 1-year maturity.
Bob?
I would support what Joanne was saying about some guidance, and perhaps rather than trying to struggles you had writing guidance, maybe through the example section, you could come up with a couple of examples and make it clear how you would be considering relevant inputs from beyond whatever the contractual period is, and give a couple different loan fact patterns. I think the CRE loan with a short-term maturity but a long-term amortization where there really isn't any expectation of repayment would be a very common example that would benefit institutions as a whole. So I think the View B approach is, I think all 3 banking agencies agree with that one. And I think that type of example guidance would be useful for all institutions. I know when we struggled before seeing this issue repeatedly with how should allowances be estimated under CECL for these types of loans. We keep talking about, well, what's the refinance risk, but we really had to struggle with how you explain that, how you communicate it. So I appreciate Mark's comments there. So if there's a way that you can do it with help of the whole TRG, I think everyone would benefit.
Sydney?
And I actually was going to echo what Joanne was suggesting about changes to the standard. I mean, I think one thing that's helpful that maybe could get baked in somewhere along the way is that in this memo, you guys went down the path of saying, well, wait a minute, this is different than the contractual term, focusing on 30-7, talking about the collectability. So, I mean, I think maybe hitting on that point would be helpful, because I think otherwise people would say, oh, well, that's looking out beyond the contractual term, and that's not where View B landed. View B is about assessing the collectability and using all the information that you have.
I hope I'm not the only one that's confused, but I just want to make sure we're not trampling over what we agreed on View A for the last issue. Because I thought there we said you look at the contractual terms, and even if there's a history of extending, don't go there. Now, I understand if you're doing a refinancing and it's in a scenario where no one else would come in and be willing to, step in and fund the project, now it's probably a TDR, so you would have to consider that. But maybe I just forgot my decoder ring, but I don't know what we've decided now, and I'm a little bit concerned that we're trampling the prior decision we just made.
I think, John, that I agree with you, and I think that's why it's important. Again, Kevin, I thought raised this off the bat, is that you should only think about the ability to receive your contractual cash flows, considering the extension discussion we had. So I think, yeah, if you've got a 5-year balloon and it's on a 20-year AM, I don't think, and your history has been to just do 4 more loans, but that's not contractually provided for. I don't think you can consider that. But I do think you can say, well, but we know how these things have performed historically, and because of that, we know that any other bank would hop in our place in a heartbeat and refinance this, and so it's likely that we would be able to collect our contractually required cash flows. So I think you can consider performance beyond the contractual period in regards to the collection of your contractual cash flows. What I don't think you can do is, like you suggested, I don't think you can say, well, it's a charge off 17 years down the road, and that's the thing we're looking at, because that's not in your contract. Does that sit better? Which is a little more view C, I guess, than maybe. So I'm throwing in view C. There you go.
Well, I'm not sure, I'm sorry, I'm not sure the views are really very helpful here, to be honest with you. I think we should kind of try to identify really what the issue is, and I think, Graham, you identified the issue. I think I tried to do that in the front end as well. Let's identify what the issue is, and then the solution. I think the staff solution is a solution to a different issue than what's listed in A, B, and C. But the solution that you have there, I think, is consistent with the issue that I brought up, and I think that Graham has been discussing as well, as to whether you have the ability to consider information in a future period, future information set, to inform the losses that you have within your contractual period. And I think that's where we should focus on.
Yeah, I mean, frankly, I don't know what the difference between view B and view C are. They're kind of the same thing to me. I mean, how do you assess another bank's ability to refinance your own borrower, other than whether or not you yourself would refinance them? But I think Kevin made the point correctly, and I hate to make an analogy to the Card Act discussion, but I think it's the same thing. You're using reasonable and supportable information that extends beyond the measurement date to inform the credit risk that exists at the measurement date, right? You're not taking losses from a future period and pulling them forward. You're trying to understand the credit risk inherent in the balance at the measurement date using information that is reasonable and available.
And so, just to summarize, sorry, one more.
Yeah, I mean, I would say, when I say view B, I think, Kevin, your point is right. I actually don't think the views really articulate kind of where we are on this. And I just look at it as considering information beyond the contractual date. Because if you end up with the contractual date, you end up with a huge loss on a project like this, where, on this kind of an example. So I think that, in that regard, I think it's considering information after the contractual date to inform your decision on credit losses.
Sorry. Shihab?
I'm not disagreeing with the discussion. I think you should consider. So I'm actually outside of that. I am still struggling with question A. By doing what we're doing in the second issue, we essentially has a hypothetical period of time to evaluate credit losses, and that hypothetical is contractual plus sum. That sum could be extended by us as a lender or the next lender. That's how we're looking at the credit loss, the way that we are framing question 2. So it's kind of weird to go back to A to say we're only looking at that period. No, because the data you collected is for the full term, which could include your extension or another bank's extension. That's what I'm struggling. I mean, I agree with the results, but I'm not sure conceptually how to make it consistent.
John?
Yeah, maybe just on a simplified example, I think, if we've got this 1 year, it's a 3-year project. If we're talking about by the end of, on the balance sheet, do I feel like this project is still on track such that it would get refinanced, whether it's me or someone else, at the end of the year? And not necessarily say it's going to be a big loss because if I had to sell the project, it's only, 20% built. I wasn't necessarily assuming that the scenario A people, or maybe they were, but I wasn't assuming they would say there's a big loss. I think they would say, well, if it's still on track, it'll get refinanced. I don't know if that's an A, a B, or a C. That's my concern, is I think different people, and maybe it's to Kevin's point of, I don't know if the views and how they're articulated are really fleshing this out, but I would have thought, just practically speaking, you wouldn't say, could they repay? You would just say, well, I know it probably would be a refinance with me, but if it's on track, that's someone else would. If it's not, then I probably am having a TDR right now, and I need to think about the next period and think about how ultimately this would get resolved. Jim?
I just wondered, for summarizing, whether it's actually useful just to get rid of the views and have the minutes reflect some combination of Kevin and Mario, because I haven't heard really any disagreement with that. With, the challenge seems to be what Mark talked about. Operationalizing that has been a problem historically and will be a problem in the future in terms of any individual fact pattern. How do I measure that when you have one of these? But that seems to be a clarification of the principle that says reasonable and supportable information does not constrain you in this fact pattern.
Chip?
Actually, I was going to say the same thing that Jim did. I mean, it strikes me listening to around the table, maybe why you heard different views is because everyone was saying, it seems to be saying the same thing, which is in this fact pattern, to stick with that, you have a 1-year loan. So we're going to look at it like a 1-year loan. Okay, well, at the end of year 1, how is this person going to pay you back? And however that person is going to pay you back is what you need to capture in your modeling. And I don't know that we need to call that view A, view B, or view C, but that seems to be the concept that we're all agreeing with, and maybe just articulating it in the minutes that simply is the way to go.
Yeah, and so basically, just to summarize, I think.
Wait.
Oops, sorry.
Doug, one more.
Yeah, I agree. I think the fact pattern that's presented here and the views that presented here artificially try to limit the scope into what is a much broader issue and how that prevails, because in fact there are many recoveries and other outcomes that happen after contractual maturity, whether it's on this type of fact pattern or a 525 or even on a installment loan. So you have many situations where there are cash flows that are coming in that are recorded in the historical record, your historical loss record, that happen after contractual maturity. And so to not be able to think about those as far as understanding the probability of default and loss given default in that respect, and the ultimate expected credit loss would artificially limit, I think, and artificially boost your estimated credit loss above what it would really seem to be given the fact pattern, or given all of those fact patterns combined. So I think you have to take a broader approach and say that all relevant inputs, and then maybe give some examples that would be helpful to individuals in assessing that.
Okay, so to summarize, it seems like people want this to be broader than just kind of the short-term lending, and there seems to be no. We agree that in the example, a contractual term is one. This is not a contractual term question. We answered that in issue 1, and then it seems like everyone believes that you can consider the information, with 30-7. And 30-7, at least in our interpretation, does not say in there it's constrained by the contractual term. So I guess the question is, are people looking for additional guidance? It sounds like some people would want examples. The problem is that, if you want us to weigh in on what information, is in or out, it didn't seem like that goes with the principle of CECL. But are you looking for a codification improvement to 30-7, or practice will figure it out? It sounds like a couple people want examples.
I would go with clarify in the minutes. In the minutes of the meeting, clarify that what was discussed around the table, and that would seem, in my mind, to be sufficient.
Yeah, no, I agree. We won't do it with the view.
Make an example. Yeah.
Okay, great.
Doug, did you want to say anything?
Oh, sorry.
Yeah, I think that's fine, as long as we clarify it in the form of the minutes and are able to expand on the minutes. That's right.
Okay, so we got about 20 minutes before lunch, so why don't we go ahead and start the vintage disclosure discussion? And then if we have to continue after lunch, if we have to continue after lunch, we will. So, all right.
We can always cut lunch short or cut it out completely. Too,
Yeah.
So.
I object.
So keep your comments short. All right, so we'll move on to the next issue. It's memo number 16. It goes following along through the memos. It's on the vintage disclosures for revolving loans. So stakeholders raised questions through a TRG submission about the proper presentation of loans initially established as a revolving line of credit that later converts to a term loan within the vintage disclosure. Some of the views on the proper presentation of these types of loans include the following. So view A, the loans should always be included in the revolving loans total, even after conversion of a term loan. View B, the loan should be presented in the vintage year that corresponds with the start date of the term loan, that is the conversion date. View C, the loans should be presented in the vintage year that corresponds with the origination date of the original revolving credit arrangement. View D, entities should make and disclose a policy election by class of receivable and apply either view A, B, or C. A fifth view was raised during outreach, view E. Under this view, term loans should be presented in the vintage year that corresponds with an entity's most recent credit decision. And then finally, a sixth view was raised after issuing the TRG memo, view F. Under this view, an entity would add a separate column for revolver loans that go to term. Therefore, an entity would not transfer the revolver loan to an origination or start date column, but instead would have a separate independent column. So during outreach prior to the TRG, most stakeholders opposed view A and noted that presenting a term loan within the revolver loan column would be misleading to financial statement users. It would not meet the spirit of the vintage disclosure requirement. The staff agrees with these stakeholders and does not believe that view A would provide financial statement users with decision useful information. During outreach, some stakeholders raised concerns about the operability of view C, and others questioned whether these types of loans are material relative to the overall size of an entity's loan portfolio. Other stakeholders provided various feedback, and they were supportive of either B or D. Given this feedback, the staff decided to seek additional feedback from the TRG members and observers about which view, other than view A, would be the most beneficial to financial statement users while balancing any operational concerns. Regardless of the alternative and consistent with outreach, the staff believes that the need for additional disclosure requirements should be carefully considered. So the questions for the TRG are: 1, does the TRG have any feedback on the staff's interpretation of the issues in the memo? And 2, does the TRG believe that entities should be required to disclose additional information with respect to the presentation of revolving loans that have converted to term, regardless of their views in question 2? If so, what additional disclosures does the TRG propose, and would additional standard setting be required? So with that, I'll turn it back over to the TRG.
Sorry, Kevin, go ahead. I was looking at my paper.
I think we're in the view E camp, or the most recent credit decision. And I think that makes the most sense from the standpoint of you capture a couple of things. So 2 examples. One example, if you have a home equity loan that's an interest-only period, and then at year 10 it flips to become basically a term loan, and it terms out for another 10 years. That situation would probably be on day 1, because there's really no credit decision, it just flips. So it'd be the first day of that one. And then another situation, maybe you have a commercial loan that you have a revolver, and you decide to term out a portion of the revolver, well, you're probably going to do some underwriting to determine why you're going to term that piece out. Maybe there's expansion of the business, so you're going to term a piece out, keep the line going. Maybe a contraction of the business, something of that nature, so you're going to have a credit decision at that point in time. So that seems to make the most sense from our perspective in terms of which column you put it into.
Jeff?
So I just wanted to say whoever came up with view E was clearly brilliant. And let me explain what I meant when I came up with view E. So how I was thinking about, I really see view E as a combination of view B and C. And so if it was part of the original contract, it was automatic that it was going to convert, or it's an option, then I would look at, first of all, I don't think new loan guidance applies because it's not a modification. So I would use the original origination date, and that was the date that the last credit decision was made. You see, if it wasn't part of the original contract, it seems like new loan guidance would apply, or it would be a TDR, and then I would use the date it converted to term. And so I was also thinking about it in the common loans. I think of both scenarios. One would be a HELOC, and I was thinking of a 15-year draw, and then automatically converts to term for 10 years or something like that. And then credit cards, sometimes when they become delinquent, they'll term them out and say, look, okay, we're cutting you off, and we'll have a 5-year repayment plan. And so for the HELOCs, I think I can get whatever information I need as a regulator. So I'm just trying to be helpful. If I was a user of a financial statement that didn't have that ability, but so I would have the HELOCs starting, even though they were in a revolver, flow through the table from day one, and you could just describe the line item as revolving HELOCs, year 1, 2, 3, 4, 5, and then prior. And that way, I think if you didn't do that, if you just waited till they termed out, you would just move from revolver to prior, and that really wouldn't be that helpful to folks. But I do think it is helpful to know when they go from revolving to term. So I would have a second line that says HELOC in the term period, and then I would flip in the over 5 from revolving line item to term line item.
Fred?
Oh, yeah, I think the ideas from a user standpoint, both that Kevin and Jeff articulated, is the right way to think about it. It is that essentially a view D, but for option A, and whether you do B or C is determined by when the credit decision is made. I think from a user standpoint, that's going to be important. I think as a user, I would like some disclosure about the amount of these revolvers that do flip to term when they do it, even though there's not a new credit decision, because in general, home equity loans that don't get refinanced and go to term after 15 years would feel from a bank analyst or a lender analyst standpoint as being higher risk. So some disclosure along those lines certainly would be helpful. I'm not sure it's possible, but it certainly would be helpful in addition to that kind of the way that this is laid out.
John?
Conceptually, I agree with view E, but I do wonder if we're limiting this to the credit card revolver flipping into a term loan, and how to reconcile it with the language that leads into what the disclosure says as far as to whether a modification is viewed as a new loan or not. I think the credit decision is the important thing, and so I would almost, I guess, two things. One, are we limiting it to revolvers flipping into term loans, or do you need to think about revising the lead into that table so that we're treating everything consistently? Because in a lot of circumstances, you're going to have a loan that's up for renewal. It's a new credit decision, but maybe we don't modify it enough that we call it a new loan. A credit decision's being made. Which vintage column does that belong in for things that are already in the table?
Marion?
I was going to make a similar point. I was first going to say I really like view F, but I know that we won't support view F, and I think view E is the conceptually best answer. But I do think that there's a discussion to be had about whether you need to clarify the new loan versus modification lead into this disclosure, particularly when you get into the discussion of what do you do with modifications to troubled borrowers, because those are not new loans. So I think it makes sense to put them in the appropriate column, but I see a conflict with guidance in the statement. I guess that's it.
Mark?
I just want to get clarification on view F, because I think I'm really view F, if I understand it right. So that would provide separate disclosure and effectively it would put these in a separate column?
Yes.
Is that right? Okay.
So when the revolver goes to term, instead of moving it to any of the other 5, columns for origination date or the prior bucket, you would just have a separate column that says revolver went to term, or however you title it, but that would be the theory.
Okay, so then that would give the user some transparency into the amount of these instruments that are out there. And I guess that could be, to the extent material subsequent, you could add some footnote as well, explanation of, the composition of that line item if it was significant. But yeah, I think I would support that view. I agree with John on view E. I think I understand your point correctly, that it would seem like an odd change to make only in this fact pattern, whereas all of the other instruments would be put in their origination bucket, not according to the credit decision. It just seems like an odd decision to make just for this subpopulation of loans. And then I did want to make sure from a preparer standpoint I'm interested that the preparers are supporting view E, and I'm wondering if the credit decision is something that's already subject to SOX controls, because I think about, okay, well now if that becomes subject to SOX, then now you have to, think about documentation and controls around defining a credit decision and then evidencing, obviously, when the last credit decision took place for SOX, or maybe that's already being done, but it just seemed like that would be something really new to bring into the financial reporting system if we went with E. And so I just wanted to see if I get some feedback from preparers on, is this something that is already part of the internal controls over financial reporting, and so it would be easy to do, or would there be some incremental effort associated with that?
So, Mark, I mean, just from our perspective, I think we didn't think about it that way. So when you describe it that way, that gives me pause. I think the way we thought about it was if you use your HELOCs that just convert by their terms, right? Nothing's happened. It's the same loan that it was before, except now it's terming out instead of revolving, and you can just move that or leave it in its original column or move it into another column. If you have a modification, you generally know whether it's a new loan or not, right? You refinance it at market terms. Generally speaking, those are always new loans, and you should have something in your system, in most cases, about the new loan date that you can pick. And again, there'll have to be controls and procedures put around that. I think all of us have to do that. And you can identify that date. And if you modify something in a TDR, you just generally know what those are. We're already making disclosures about TDR, so we can go pick that data as well. So it really wasn't baked in what's the credit determination date. Do we have SOX controls around it? It was really just sort of rationally thinking about how we can put things in these buckets.
Gia?
I mean, I agree with view E, and not in the context, Mark, you were thinking for SOX control. But to John's point, though, I conceptually agree with the scope should not be limited to this, but I am worried a little bit about the practicality of how to do it. Because if I don't have, let's say I don't have the new loan in my system, although it's recredited, right? So now I have to track in my loan system with an accounting field to say that is actually required disclosure. I think that modification to all the loan system we have may be, I don't know if it's worth the efforts at the end of the day from benefits perspective. That's just practicality wise, I agree conceptually. I'm not sure if I would spend the money to do it. I don't know what the benefits are, so.
Maybe just in defense of view F. I mean, we do have pretty comprehensive disclosures today on modifications, TDRs. And I think, I don't know if all of us, but some of us already provide disclosures on HELOCs and end of draw and what's going to hit end of draw. It may not be by vintage, but we do provide that type of disclosure and transparency. So some of what we're concerned about here may already be in our disclosures. And if we're worried about SOX controls and data and what's a credit determination, what isn't, view F, maybe with some enhanced disclosure around view F, could be an alternative.
Bob?
I just wanted to get a little more of an understanding of the view F, because I thought, Jay, you had said a single column, and I would think over time you'd be accumulating different loans going to term in different periods, and then you end up in the same position as the prior column in example 15. It's a whole bunch of different periods of time. Is it really that informative to users? Or whether you're talking about multiple columns depending on which year it goes, which seems like additional cost and burden and controls are needed. So just trying to better understand.
Yeah, so we weren't thinking of doing like a vintage for the revolver move, I guess. We were thinking of just a single column for what has moved. So in total, what's in the term loan bucket, there was once a revolver. But I hear your point on, should it be by vintage year within the revolver that's going to term?
Yeah. But Jay, I think that the distinction between E and F, well, there was no distinction. Because if you're talking about these longer dated HELOC types of loans, they're going to end up in that beyond 5-year category anyway. So this was a way to give the investor a little bit more information instead of burying it in the, beyond 5-year column. You'd actually split it out so you'd pick up an extra column. So instead of having 7 or so columns, you have an 8th column, and that would be splitting the revolver column into, okay, those have migrated from revolver into something new and different. I agree with you. I mean, ideally, you'd have that going to term column broken down by vintage, and some investors, as we've kind of talked to them about this, would love that information, but it's kind of a practical cut. At what point do you double up, triple up, quadruple up? So this is really, F was a practical approach.
I mean, would it help if you took view F and split it into two columns, sort of your conversion by their terms and then TDRs?
You tell me, is that operable?
When we know we're disclosing TDRs already.
There's a hurricane coming to
Tim, are you okay?
Absolutely.
So I wanted to clarify view F too. So what I thought you were saying was that it would show up in revolver only column while it was in revolving, and then it would move to revolver to term when it termed out. Is that so it would be in two different
there's two
columns.
columns.
It would move from
Just
one
one
column to
separate
another.
column. It'd be a different
Yeah. And just to your point, I tried to address that point in view A when I was explaining it. I would actually start in year one, even though it was revolver from year one, to show, but I would describe it as HELOC revolver in the line item, and so that I could see the vintage of how much HELOCs I originated each year.
You would actually create a product category.
I'd have two rows. I'd have HELOC revolver row and HELOC term row, and it would move across the revolver row until prior, and then it would drop into the prior term row.
What would you do on credit cards?
I feel like if in the example I was using, where it was a revolver and then you just stop them and you're just trying to collect what was left, I feel like that's kind of a new loan. So I'm not even sure I'd put it. It would be a TDR. I don't know if I'd include that in credit cards, or maybe I need two rows in credit cards with term and normal revolving credit card.
Dan?
Yeah, I was just going to say, I'm also attracted by a view F. I like view F for reasons Mario articulated and Hal as well. And yeah, we do already today have extensive TDR disclosures, and we have about a page of disclosures on HELOCs and conversions related to HELOCs. So a lot of that does supplement what's there. But a column F, separating that out, I think highlights the point that was made on additional credit risk that's probably there as well.
All right, Kevin?
Yeah, we were in view A, view E, and we still think that's an appropriate view. I guess we could probably get behind view F as well. Well, at least what we heard from, at least as it relates to credit cards, is that when a cardholder stops paying and they go to some sort of payment plan, they don't really view it as a term loan. They just view it as still managing the credit exposure on their credit card. So I think that would, so in other words, they would probably like to have left it in a revolver column. So I think this view F would probably be something that would be supported there.
Okay.
So you look very puzzled.
No, I think this combination of having the, essentially a view E that only allows B and C when the credit decision is made, and then the supplemental information played itself out well on the column F. But the only thing I'm confused about is this termed out piece shows up in column F. Is it also going to show up in your termed loan vintage?
No. No, that was the practical cut that we made. So it was
Too much data in the
yeah, just revolver, go to term. We wouldn't do it by vintage year. It literally was a practical cut.
It's more of the, how did you get to that loan? It's kind of showing you the path.
That's right. Sydney?
View F would seem to be a practical accommodation. I guess I'd like to think about it a little bit more. As I think about the way these things occur today. I'm not sure that, it's not like there's new loan numbers that are being generated. It's, I don't know that people are tracking whether there's a credit decision made or not, or whether it's automatic. So this seems to be a practical way forward, but I would want to think about it a little bit more.
So I think I could get behind VUF really well as well. I just am confused because there's been different thoughts about how much disclosure or how you break out VUF. So I think what originally VUF was indicated as, you would just have one additional column that included everything that went from revolver to term. But I'm also hearing some other individuals, suggesting that within that VUF, we have to break it out by vintage there. So I just want to make sure that we're clear in that respect. And I would not be supportive of breaking VUF out by vintage if it's, because I think it's VUF, as originally stated, is a nice practical expedient and does give additional information. I think then breaking it out further by vintage gets a little bit operationally challenging.
Real quick, can we combine E and F? So if you have an underwriting decision, and then that would go in the start date column, and if you didn't have an underwriting decision, it would just go in the term column rather than all prior column? Would that be an approach that works?
So does that mean if it's like the credit card where now I'm terming it out, that's not really an underwriting decision, that's a credit mitigate losses decision, so it just goes into column F? But if this is, HELOC is due, and now let's originate a new fixed term loan, that goes in the vintage column?
Yeah, something like that.
Yep. Would the loan systems differentiate them? Would you give them a new loan number if you turned a HELOC into a fixed rate loan versus?
John, why would that not just be a new loan?
Thank you. I was going to say that.
Yeah. Okay, thank you.
That's kind of what I was asking too, because it seemed like a lot of the discussion about the VUF was credit cards and HELOCs, but not the commercial line of credit where you partially you term some out, where there is a credit decision. And I would think that one is better placed in the regular vintage column. So maybe that's kind of getting at how do you combine E and F?
Right.
That's right.
What provides the best information for the users?
When you're terming out the commercial loan, is it a TDR? Or is it, because
I just meant
I
you got a
understand
good
that to be a
customer
less
and they want
common
to term some
scenario
out.
than a TDR modification.
Yeah, I was not talking about a TDR, just a non-troubled borrower, but for some reason, the borrower's got a good reason to want to term something out based on how they were using the line of credit before, and maybe now some things have settled down and they got a regular repayment stream and they want to, use it for reducing some of what had been on the line of credit. Maybe they get a lower cost of borrowing too.
Can I jump in on that point? So I would see that, how would that be different than just I'm making you a loan to pay off the line, part of the line of credit? Like, I just view that as a totally separate.
It would be a new loan.
Yeah. Yeah.
Yeah. Mark?
Sorry, I just wanted to make sure I was following the discussion. So I think what people are speaking to is VUF with no other overlay other than acknowledging that the new loan guidance still applies and you'd still go into a separate vintage column if it was a new loan. Is that capturing the last few minutes of discussion? I wanted to make sure we were, okay.
Pretty much. Yeah.
Like, again, conceptually, this all sounds great. Like, I think, at least I would like to go back to check on most of our loan system. Mario, I acknowledge there should be a new loan, but do you really always assign a new loan number? Like, I know going through CCAR when you do stuff, it's not that easy. So now you have a loan system doesn't quite acknowledge the accounting results. You still have to bridge that. How much work you need to do actually to figure the disclosure out to build a bridge?
I agree, and I think the answer to that question is no. All the loan systems, and we all have multiple. They're all inconsistent. They capture different dates, but that's not a new issue. That issue existed the second we had the vintage disclosure. So we've all been gathering data to try to figure out how to solve that. So we have to solve it anyway.
Just a point of clarity. So what I'm hearing from a user standpoint is that when these revolvers flip to term, most of the time, if a new credit decision is made, essentially you have a new loan. that would go in the books as a new loan and go in the vintage disclosures. The only time, obviously there's going to be some exceptions, the one time that this isn't true is like on a home equity loan that naturally has this trigger, in which case then we had to have column F that would give us that information. Right. I mean, from a user, this seems like, this kind of choice of F seems like we'll get the information we need, because most of the stuff's either going to be a TDR or a new loan, except for these fairly, these termed out home equity.
Okay, so I'll just summarize quick. Seems like most folks are either in the E or F, and then perhaps the hybrid between the E and the F. We can consider it, and then perhaps even considering applying this to all types of loans, not just the revolvers. So that way, it just doesn't apply to the revolver column. So that way, it's consistent. But I think that's kind of where we are as a group. Okay. Anything I missed?
Mario, you look skeptical. Okay. All right. Okay.
I always look that way.
All right. just the way you look. All right. All right. All right. We have for the TRG members, we do have a lunch, and I will look to someone. I'm assuming that's in the
boardroom.
It's in the board dining room, which is if you go down the hall, just past the restroom, it'll be on the right-hand side, and back here at 1 o'clock. Thanks. We could maybe get started. The bell's not as effective when I do it, Hal. I don't know what that's about.
You gotta hit it hard.
Yeah.
There's a cowbell up
It's all in the technique.
Thanks, Tim.
All right. Thank you to everyone for coming back after lunch and not just taking off. Since we're about to embark on the easiest topic of the day, I'm sure it'll be easy to get through, which is recoveries. And I'm going to turn that over to Jay to tee up.
Thanks. So bear with me. This is going to be a pretty long tee up. So on the last issue for recoveries, so the final topics for today are related to recoveries. So the staff will collect feedback from TRG members and observers on these topics and will either ask the board to reconsider its previous decision on recoveries made at the August 29th, 2018 board meeting, or will include a question in the exposure draft to solicit further feedback. So the issues that will be addressed today will be: 1, whether additional changes are needed to the codification with respect to recoveries, and 2, whether entities can have a negative allowance for collateral-dependent financial assets. So beginning with issue 1, recovery. So before the June 2018 TRG, stakeholders informed the staff that there was diversity in views on whether future expected cash flows from a financial asset that had been written off or may be written off in the future should be included in the calculation of expected credit losses. At the June TRG, the staff expressed their belief that the board intended expected recoveries should be estimated and included in the calculation of the allowance. The staff also described that expected recoveries should be applied consistently to the individual and pool basis. After the June TRG meeting, the staff received numerous questions from stakeholders asking for clarification on which cash flows should be considered recoveries for the purposes of measuring the allowance. After initial outreach on the subject of recoveries, the staff recognized there was significant diversity in views among stakeholders, but observed that nearly all stakeholders expressed that recoveries should include, at a minimum, amounts received from the borrower. To align the feedback, the board issued a tentative decision at its August meeting to amend the guidance that would require entities to consider recoveries when measuring the allowance, but recoveries would be limited to amounts collected from the borrower. After the August board meeting, stakeholders identified 2 concerns with the board's decision. First, entities were concerned that any decision on recoveries would not be finalized until Q1 2019, which would hinder entities' ability to accurately model the allowance for credit loss calculations. And second, some stakeholders opposed the decision because it would result in a change from existing practice. That is, these stakeholders already consider various types of recoveries in the measurement of the allowance today and believe that the board did not intend to change current practice. Because of the feedback received after the August meeting, the staff performed additional outreach with stakeholders with the intent to pull forward or to expedite common letter feedback on recoveries. The staff asked stakeholders what types of recoveries should be included when measuring the allowance. Nearly all stakeholders supported allowing all types of recoveries in the measurement of the allowance, including cash from the borrower, which is principal and interest, collateral such as homes and vehicles, and the sales proceeds of a financial asset sold to a third party, such as the sale of a defaulted credit card balance to a debt collector. Stakeholders stated that the usage of the phrase all recoveries should exclude freestanding contracts and the sales of performing financial assets. The staff then asked stakeholders what changes should be made to the guidance to clarify that all types of recoveries should be included in the measurement of the allowance. Stakeholders generally maintain that the guidance is clear as written and that no additional changes need to be made to the guidance other than striking out the language in paragraph 32620 35-8 that states, quote, recoveries of financial assets and trade receivables previously written off shall be recorded when received. In consideration of the feedback received, the staff identified two alternatives that could be considered in deciding whether the board's tentative decision on recoveries should be expanded. The alternatives would be incremental to deleting the language in paragraph 35-8. So for the first alternative, alternative one, would allow for all types of recoveries to be considered except for sales of performing financial assets. Alternative two would allow for all types of recoveries to be considered. Staff notes that both alternatives would include the fair value of the collateral or expected proceeds from the sale of defaulted financial assets at the date of foreclosure as recoveries. That is, an entity should not incorporate liquidation values in the measurement of the allowance for credit losses. In addition, both alternatives would require entities to offset recoveries by expected selling costs and would exclude freestanding contracts from being treated as a recovery. Stakeholders supportive of alternative one noted their apprehension about including sales of performing financial assets as a recovery because including these sales in the allowance would essentially allow entities to front-load all or portions of future revenues. The staff agrees with stakeholders that treating the sales of performing financial assets as a recovery could result in entities front-loading future revenues. However, the staff also notes that because an entity could not record a recovery without having an expectation of future charge-offs, or had previously charged off all or a portion of a financial asset, it is unlikely that an entity would be able to include profits from the sales of performing financial assets in the measurement of the allowance. In addition to striking out the final sentence in 35-8, alternative one would require some incremental standard setting to amend the guidance to limit recoveries to only those amounts expected to be received on non-performing financial assets. Under alternative two, an entity would be able to consider all forms of recoveries when measuring the allowance for credit losses, including the sales of performing financial assets. Because stakeholders noted that the guidance is clear that all types of recoveries can be included when measuring the allowance, no further amendments were recommended. So the question for the TRG with respect to the first issue on recoveries is question one. Does the TRG believe that, with the exception of deleting the last sentence in paragraph 32620 35-8, further clarifications of the guidance are unnecessary for the accounting of recoveries in determining the estimate of expected credit losses? In question two, if TRG members believe that further clarifications are necessary for the accounting of recoveries in determining the estimate of expected credit losses, what additional clarifications do the TRG members and observers propose? With that, I'll turn it back over.
Mario?
Surprise. I guess I'm cautiously optimistic about what's in the paper, but I'm confused about the references to sales of performing financial assets. I don't know how to think about that. I'd be concerned if that precluded entities from their normal estimates of LGDs, which obviously would consider a future default and a subsequent foreclosure and a subsequent sale of that asset, right, which at the measurement date was a performing asset, right, to inform what the LGD would be at the date of default. I don't think that's what you're saying, but I think what's written here can be interpreted as that. I think what you're trying to say is if you actually are selling performing assets as a matter of course, you have gains, that those gains should not inform recoveries on assets that you've previously charged down or charged off. Is that fair?
So the context of which the sales for financial assets came up, they came up in the discussions when we were talking about credit card sales. So folks were concerned with including selling off something that was performing and including those sales in the allowance. So it wasn't in the context of like collateral, like homes and vehicles in that sense. It was more of like a bad debt. So it was comparing it to the credit card sales. So if they sell off a good loan, they didn't feel like those types of loan sales should be included. So it wasn't in the sense of collateral.
Okay, I mean, similar, but it's the same question, whether it's loans or collateral underlying loans. But again, I think what you're saying is that you shouldn't use gains recognized on a pool of performing loans to inform your recoveries on pools of non-performing loans.
Correct.
I don't know that anyone would disagree with that. What you're not saying is that you can't consider the sales of future loans in the determination, or let's say future collateral. You can't consider you can consider the sales of collateral on performing loans to inform your LGDs on performing loans. You're not prohibiting that.
Correct.
Jeff? Thank you. All right. Again, I was looking that way. Sorry. John, really need to.
I mean, I think on a conceptual basis, if we're trying to think about what you're going to collect from the loan, I think it's easy to gravitate to certainly cash collected from the customer or the liquidation of collateral from the customer. That's from the customer. I think that's what we're trying to figure out. But I do believe with the notion of recoveries for some entities, and I think especially in the uncollateralized, unsecured loan space, when they are defaulted, that is their form of recovery. And we would say conceptually, maybe that's just a proxy for what they would have collected had they kept it. And so I'm not sure that we would even necessarily need clarification on what a recovery is to include those three things. We would have said certainly cash from the customer, sale of the collateral, and the sale of already defaulted loans where interest rate movements aren't really informing the fair value and the proceeds as much as what's ultimately going to get collected. And I'm guessing that the loss data, and I think we try to say how much can you use your historical loss data. I'm guessing those three are already in what would be considered loss data. I don't think the sale of performing loans, securitizations, that's not ending up in loss data. And that now, to me, is something that isn't really a recovery. That's just something separate. So I think I agree with where the staff is at, and I think that puts me in an alternative one camp. I also am not sure that we would need much clarification, to be honest with you. If you just said recoveries, I think most people would agree that's a recovery or a proxy of a recovery, and that would scope out the performing loan sales. I don't know if we need that explicitly, but if others think we do, I wouldn't object.
And then Graham or Jeff, I'll let you decide whoever was first.
Thanks.
I can take it away.
Possession is 9/10 of the law. We think that there is need for further guidance, just based on reading the memo and all the discussion that happened since the last TRG, my discussions within the OCC. I think when people say, oh yeah, if you eliminate that sentence, it's clear to them what it's supposed to be, and it's clear to you what it's supposed to be, but I don't know that the same clear view they share among them. So we do think you need additional guidance, because we identified at least 4 different things that have been called recoveries in the discussions. And the first one is what we as regulators traditionally think of discoveries as just recoveries is cash that you've already received on an asset that you've charged off. But then you also have future recoveries of things that you've already charged off. And then you have future recoveries of future charge-offs. And then the base memo that the DIP prepared talked about just collateral appreciation as a recovery. So I think that we see, even though it didn't even seem to be linked to whether or not there had been or would be a charge-off. So I do think that it would be helpful to have guidance talking about, and to make sure that we're all using recovery to mean the same thing, and how we use that. The thing that feels new to me, so the first one, cash received, obviously nobody's arguing about that. The thing that feels new to me is the second thing, which is I've charged it off today and I'm projecting to recover it in the future. I think, at least for individual assets today, that would not be allowed according to the way that we understand GAAP and the way that our regulatory reporting instructions are. So if you had a house as collateral and you charged it down to you had a $100 loan and the fair value was 75, and then it became 80 before you actually got foreclosed on it, I don't think you would recognize that until you foreclosed it. So that's what feels new to me. So that's what I think, if you're recognizing a recovery on something that you've already charged off, I don't feel like it should be a contra. I feel like that should be a separate recoverable asset, and not netted against the allowance. I feel like the future charge-offs and then followed by future recoveries, we kind of think about that already today with net charge-off loss rates. So I guess I'm okay with that being netted. But the recoverable asset of something you've already charged off doesn't feel like should be a contra to me. I'll stop there. I got some other points, but I'll make them later.
A counterpoint.
Yeah, so just to respond to a bit of that, the example where you charge down to the collateral value, I mean, that's not a recovery, right? That loan's collateral dependent, right? So you're not in recovery guidance. So the only thing you can do is charge it down to collateral value again if the fair value decreases. What the deep paper, which I wrote, asked for was not to predict recoveries or forecasted changes in real estate values. What it asked for was, can we have a symmetrical model so that if the fair value increases, when it increases, you should be able to recognize at the time of the increase so that you can have, you don't have to just ride the collateral value downwards, you can also take it back upwards. But again, not a forecasted recovery.
But a balance sheet amount?
Yes.
Yeah, but that would be different than today. Do you agree with that?
Absolutely different.
Yeah. So today you would have to wait until you foreclose to recognize that increase.
That's it, gain on sale.
Under the new model, you would be able to recognize it at a subsequent reporting date if, based on that reporting date fair value. Yeah, okay, then we understand that the same.
All right, thanks. The thing that I struggled with when reading the paper was the discussion around sales of non-performing loans as opposed to sales of charged-off loans. And because I think to maybe I think I know what was intended. Maybe I don't, but I thought I knew it was intended. But I think the notion to me was you can't have a recovery without a charge-off. That seems fairly fundamental to the notion of a recovery. And so what if I had a sale of a loan that was past due but was never charged off? Could I call that a recovery somehow and further net my allowance down? To me, the answer would be out of hand, no, because you can't have a recovery without a charge-off. But that didn't come through in the paper. And so I think there needs to be clarity around what a charge-off is. And I think there does need to be, I mean, I think the fact that we've all had so many discussions is a very clear indication that there does need to be incremental guidance. The only other thing I would say is I think this kind of went beyond the initial discussion, because I think when the initial discussion on recoveries came up at the last TRG, it was, if I have charged off a loan, can I consider cash flows I expect from that loan in estimating the allowance? And I think as Jeff alluded to, yeah, we use net charge-offs today. Everybody does. So I think that's right. But this seems to be asking a whole other question altogether. And so anyway, I'm afraid that this has gotten perhaps more complicated than it needs to. I think everyone agrees recoveries are something you can and should consider. We do today. It's consistent with the model. I think the question is what is a recovery, and does that include sales of an asset? From my 2 cents, I'd rather it didn't. I think sales of assets we've always applied contingent gain guidance to, but that may not be where everybody is, and I think that's fine. But I think there needs to be clarification about what a recovery is, and it needs to be linked to the notion of a charge-off.
Dan?
Yeah, just to try and respond to those comments. I mean, I think that, if you've got a credit card receivable and it's going past due, and it may still have, performing status because you don't have a non-accrual, your policy may be to continue to be on accrual status till it's 180 days past due and then write off that credit card receivable. But it could be, let's say, 60 days past due or 90 days past due. It's not current, and so from a layman's terminology, from performing status, it's not, performing, and that would be a riskier receivable. those do get sold into the marketplace, and there's proceeds from that. I agree, there hasn't been a charge-off, so I guess technically, maybe that's not a recovery, but that informs our loss rates on our credit card portfolio. And if I'm precluded from factoring that into my loss rates simply because I didn't have a charge-off, so when I sold it, when it was 60 or 90 days past due, it's troubled, I'm getting proceeds, less than par. I think I should be able to include that in my loss rates that I'm applying to the portfolio. And yeah, exactly. So I just want to make, I don't know if we agree on that point or if we're jump in there.
Dan, that makes sense to me. I guess where I got confused is I thought the initial discussion, the initial TRG discussion was, can you think about cash flows on charged off loans? And so that was my recollection of the initial discussion was if you have a fully charged off loan, but you expect future cash flows, can you think about that? And so that's why I was confused about non-performing loans that hadn't had a charge-off discussion in this paper. They seem disconnected from the way I remember the initial question anyway. So, but I don't necessarily disagree with what you said.
Chip?
I think there's as I listen to this conversation, there's a risk that we're using terminology that has very specific meaning in the banking space, and people outside of the banking space may not think that way, right? So perhaps in the context of the banking space, you think about a recovery as an amount that relates to a loan that was charged off. I think if you go outside of the banking space, a recovery is defined more broadly as I lent somebody money and I'm going to recover that money back from them, i.e. they're going to pay me back. So I think the original TRG discussion, I think, was kind of centered around the concept that I thought the model was about the balance sheet should reflect what you expect to collect from the borrower. That's what should be on the balance sheet. So whether, and in thinking about that, we've thought about it, there's different kind of phases of CECL that you could be in. So you could be in a phase where you haven't charged anything else off, you have just an allowance. And should we be thinking about, what should we be thinking about in that context? And I think the answer is, we should think about everything. Should we think about whether the borrower is going to pay us back? Yeah, probably. I mean, that's the whole point, right? Should we be thinking about collateral? Should we be thinking about all those things? Okay, great. Then you move to this, this charge-off concept, right? Which different people will have different judgments outside of the banking space on when a loan is charged off. And so then the question becomes, should you be thinking about the purposes of CECL or what we're designed to do simply because we've collapsed the allowance against the amortized cost basis of the loan, which we call a charge-off? And I think what the TRG decided or discussed then, and what still makes sense to us, is no. The fundamental concept of CECL is the balance sheet would reflect whether or not what I expect to collect. So whether or not I've reflected that via an allowance or via charge-off, the answer shouldn't change. Nor should the answer change whether or not you're trying to measure things at a portfolio level or at an individual asset level. Then I think the question that got raised in the paper, Mayor, that you wrote is, okay, well, that's two elements of CECL. There's more elements of CECL. There's when you're in the collateral-dependent practical expedient, and the fair value of the collateral increases from what it was previously. Should we have a negative allowance, or should we reflect that in our calculations? And it strikes us, the answer is yes. I mean, if the goal of CECL is to reflect on the balance sheet the amount that you expect to collect, well, whether I'm using a measurement methodology that gets to an allowance, a measurement methodology that creates a charge-off, or a measurement methodology where as a practical expedient I'm focused on the fair value of the collateral, if the fair value of the collateral increases, seems like we should book that, because that's getting you back to the overall goal of what CECL is supposed to do, is what's on the balance sheet. As for this, should we separately classify the recovery on the balance sheet? I think we're kind of with the staff that we shouldn't do that, largely because I think that it gets back to this, okay, well, you're going to separately classify on the balance sheet an expected future cash flow based solely on the decision of whether you charged something off previously. So if you have somebody who hasn't charged off, they'd be reflecting those recoveries as a reduction of the allowance. If you have someone who did decide to charge it off, we would classify it differently. And that didn't seem to make sense to us. Where we do think the guidance could be clarified, to answer the question that you asked, is, this concept that it's okay to have a negative allowance, that it's fine. I think that would be helpful to clarify in the guidance. I don't know that, I think people that have been participating in these discussions and are in it every day kind of understand that, but I think people outside of that read an allowance as a reduction of this, and they don't think of a reduction could be a minus of a minus, and therefore it's a plus. I think Mario taught me that math for what it's worth. So anyhow, that's kind of how we think about it. We think about it a little bit more holistically, and the worry sometimes when we get trapped in these discussions of, well, let's define a recovery or let's define a charge off. It becomes very difficult, and that may only be useful to people that are following the regulatory guidance where they may all have a same common definition that they're following, which probably doesn't exist outside of the space. That was a lot, so apologize.
Bob?
Thanks. I wanted to go back to the discussion about the sales of the non-performing loans that haven't had a charge-off. And maybe this isn't done in GAAP financial statements, but for at least since 2001, the agencies had a policy that if you decide to sell a loan, presumably you have to move it to held for sale, or at least conceptually you do. If it's all instantaneous, it may not go through your books that way. But if the sale price is such that it really reflects a credit loss, you need to report that as a charge-off. Otherwise, because of what we were seeing, banks were selling a lot of non-performing loans, and no loss data was ever showing up in their statistics on charge-offs. So there's a concern of an understatement of the realized credit losses for charge-offs. So it would seem that if banks are selling non-performing loans, but even before a charge-off, at the time, if there's really a credit loss embedded in that sales price, when it's transferred out of held for investment or instantaneously when the sale occurs immediately after decision, you need to reflect the charge-off, which will then affect your long-time, your historical loss experience data.
And that's actually in our guidance where it says you have to consider write-offs prior to the transfer. So just to respond to that, the difference between either reg or GAAP. So when you're doing the transfer, you say, okay, well, is this decreased any of that due to credit loss? Take the write-off, transfer it into held for sale. So I think that's consistent. Joanne?
Thanks. I do think it would be beneficial to
Last question, so make it a good one.
make it a good one. Get everything in.
We're going to be here a while.
I do think it would be beneficial to provide some clarity, whether it's to explicitly define recoveries or say we're not going to provide a definition and we're looking at all these cash flows. I note that in paragraph 30 of the paper, there is implicitly there's a discussion that recoveries imply a charge-off, and so then I think that would be a way to then think about recoveries, and then the question about sales of loans on sales of NPLs where there's been no charge-off, that would be within the question of, are there other cash flows and events that should be considered within your expectation of cash flows? So I think you could look at those, let's specifically define recoveries in the context of charge-offs, but then also ask the question about what other cash flows should be included when you're looking, trying to estimate your allowance.
Mark?
I have a couple of comments on issue 1. Before I get into that, are you gonna separately tee up issue 2, or are you taking comments on? Yes. You're okay. You're gonna separately tee that up. Hey, I agree with some of the comments that have already been made. That I think this issue, which started out pretty straightforward, has sort of just spun out into issues that I didn't really think were questioned. So I think the whole genesis of this issue is entities who have a significant amount of recoveries on assets that were previously charged off, especially financial crisis era receivables, and that had they really have some significant expectations still around cash flows, because for reasons stated earlier, a lot of these recoveries take a while to come in, and so there was a question about whether or not they could continue to include those cash flows on previously charged off assets in the allowance, and there was a sentence that was going to preclude it, and that's been a sentence that's been much talked about. But that really was, I think, the debate in practice, and since then, I think this has become bigger and more complicated than maybe the practice issues really were. But just in terms of the questions that were being asked on sales of performing assets versus sales of charged off loans, I do think there's a little bit, I'll acknowledge there's some conceptual inconsistency with the idea that you would include cash flows from charged off, the expected sale of charged off assets versus, and not include proceeds from sales of loans that maybe you're anticipating sale, haven't yet been able to reclassify them as loans held for sale, but you're anticipating sort of normal course of business from sales of performing loans. But I think that conceptual inconsistency makes some sense if you include sales of performing loans. If I understand that suggestion properly, that would almost accelerate held for sale accounting, but even worse, it would do it in a symmetrical way where you could take gains and losses when loans held for sale are supposed to be low com. So once you identify a specific loan for sale, it would be low com. But if you can include the cash flows on expected sales before that, then you would be able to include both gains and, expected gains and losses. And so agree that probably wouldn't make sense. But I do think that distinguishing between sales of charged off assets and sales of performing loans does make sense from a financial reporting standpoint. I actually want to bring up a different issue as well and just get some clarification. I mean, we left the last TRG meeting with, should it be an option versus should it be a requirement? And I think the board came back and said that this should be a requirement. I think we continue to have some concerns about that. And I did notice in the earlier discussion, somebody said, recoveries are not systematically tracked and monitored. And I think I agree with that, right? That, there's not a lot of data around recoveries. And so I think that when it comes to estimating recoveries on previously charged off assets, that could be very burdensome for people. And so this requirement to include that, I think, is very, very significant. And I had a little bit of reaction to, some things in the paper that seem to imply optionality, particularly, I think, paragraph 10, which talks about almost, it should not be included if you don't meet 30-7 or 30-9. And I think I'm sensitive to it because we should have clearly stated requirements. We should have clearly stated options. And I just wanted to get some clarification on whether the guidance in paragraph 10 was meant to say, if you think that there's going to be undue cost and effort in estimating recoveries on previously charged off assets, that, you don't have to do it. And you could point to 30-7. I think it says 30-7 through 30-9. So the sentence I'm focused on, to be clear, is one that says, therefore, an estimate of expected recoveries should not be included in the allowance for credit losses if that expected recovery input or assumption does not meet the requirements in 30-7 through 30-9. That almost seemed to be the staff giving a wink and a nod to people who just wanted to exclude recoveries by pointing to these paragraphs. So could I just get a clarification on if people think it's going to be difficult or challenging or burdensome, do they have an option of just including it as zero?
So that wasn't the intent of that wording. That came from our discussion that we had back in June. And I think at June, when we talked about recoveries the first time, whether it's in or out, and we talked about the notion of an option, we didn't think there was an option because I think all we said was, look, if an entity doesn't have historical data or there's no reasonable and supportable information, then don't include a recovery assumption. So this paragraph 10 was a carry forward of that. And in August, we clarified at the meeting and the board decided that it is required. So there is no option for it.
Okay, so if you don't have historical data or whatever, or it'd be difficult for you, you still need to do it.
Yeah, I think all we're saying is you should be following the guidance in paragraph 3-7.
Okay. Thanks.
Doug?
A couple of things. First on what Mark just said, I do think that is a relevant issue. And in terms of that gets into interpretation then, and then an audit and prepare a conversation around what is, reasonable and supportable documentation on recoveries. And I guess I was under the impression that we left, leaving some flexibility in the preparer's hands in that respect, that if it was, extremely challenging or unduly burdensome to try to find recovery information and apply it to the right segment or whatever the case may be, that there was some rationale or some ability to not include that recovery information. So that is a little bit different from my interpretation. Second, back to the other issue, and I think the basis of CECL is really trying to take a look at what are the expected cash flows, and more specifically, what is the expected loss over the lifetime of the loan related specifically to credit. And I think it's going to be, as with many things in CECL, it's going to be hard to issue hard and fast guidance or hard and fast clarifications. I think if we go back to the basis for which CECL exists, which is cash flows related to credit loss, and we take a look at these situations of sales of performing versus non-performing loans, when you get to the basis of what is the primary factor causing the change in the sale price or the change in the amount of cash flows collected, and if the primary factor is basically credit loss, then I think you should include that. So in the example of where you're selling credit cards that are 60 or 90-day delinquent, you're probably selling those credit cards at a discount. And that discount is primarily probably related to the fact that they're 60 or 90 days delinquent, and not related to fluctuations in interest rates or the various other things that get into gain and loss accounting. So I think, I don't know how you codify that into a specific, example or set of examples, but I think if you relate back to what is the rationale for CECL, and when you're considering the rationale for why those sales are occurring, and include those because that discount is related to primarily credit losses, then it makes sense to include those in terms of your calculations when you look at the portfolio or the initial loan and what the expected credit loss is over that portfolio's life. Not sure I said that succinctly or clearly, but that's,
Made sense.
Yeah.
Jeff?
So two things. One, I wanted to address Chip's point about not having a separate recoverable asset. I get your point in general, but for me in banking, like when you've made a specific decision on an individual asset that has been deemed uncollectible, and then you're kind of reversing that decision, you're now saying, oh, I'm going to collect something on this thing that I previously individually identified and deemed as uncollectible. That feels different to me than just saying, oh, my pool allowance is now going to be less because of general other things. So that's why I was making the argument. I understand your point, but that's how it seemed different to me, and I agree that's probably specific to banking. It may not be applicable to other industries that have different kind of charge-off and practices. The other thing is on this notion of selling non-performing assets. I'm wondering if we need to define non-performing, because I don't think there is a consistent definition that's being used for non-performing in disclosures today. And also on the notion of selling performing or non-performing assets, we haven't really talked about how that would work for HTM securities, because obviously you've made the assertion that they're held to maturity, so I don't know how you might necessarily say, well, I plan to sell them now. I'm talking about performing, right? Because we're talking about whether performing's in there, but can I consider sale of performing assets? I don't know how you could do that for an HTM security. I don't know if we're going to say you can do it at all, but that's another thing we'd have to think about, I think.
Graham?
Thanks. I guess, and I'll try not to bleed it. We've bled a little bit into question two, and I'll try not to bleed into question two here. But I guess the thing I would say is I think the discussion is sort of brushed over, as Jeff actually just mentioned, the charge-off notion. Charge-offs happen when amount is determined to be uncollectible. They are different than expected losses, right? An expected loss goes in allowance and it can go away. But you write off the amortized cost basis of an asset when you believe that amortized cost basis is not collectible. And I think that matters. And so I think there's a distinction between an amount that's in an allowance and an amount that's written off. And I understand that there's banking practice that requires you to charge off amounts that you might deem to be collectible, but that's not a gap issue.
I just have to respond to both of those comments. I mean, you can't disregard that. The fact is, yeah, we make judgments about what's collectible and uncollectible, but most of the time we don't. We're charging down because we have to per the regulatory guidance. And regardless, what we charge down to is still a judgment. It's an estimate, and estimates change.
No, I appreciate that, Mari. I do. I just think that's just kind of how GAAP works everywhere, not just in financial instrument space, is that when you write things off of the amortized cost basis, you usually find yourself in contingent gain guidance. You think about fixed assets. You take a 360 impairment, if the value of the asset goes back
Outside
up.
of ASC 450.
What's that?
So that guidance no longer applies.
I think that's just I mean, we're moving to the second question. I don't want to too much, but I do think, we've got to think hard about whether or not write-offs of the amortized cost basis are just something we don't care about in financial asset accounting. I think that's a question we've got to think about, whether that matters or not.
So are you raising a recognition question or a presentation question? Now I'm confused. It sounds like you're questioning whether or not we should even recognize the recoveries.
No. I think, well, we're getting to question two, and we'll do that. But I think the notion in CECL is not, the way I've understood it and the way I think it's written today, is not to say just all the amounts you expect to collect. I think it is the amount of the amortized cost basis you expect to collect. And I think that's an important distinction. And I think that's why it's written as the allowance is a valuation account that reduces the amortized cost basis to an amount you expect to collect. I believe it's referring to the amortized cost basis. So, again, and I'm sorry, we're starting to bleed a little bit into question two, and I don't intend to do that. But I just think that notion of charge-off is important, and we need to think about whether or not it's a substantive matter to consider.
John, do you have something right on point?
Yeah, just to respond to the financial versus non-financial asset, I think there was a conscious decision to decide that for financial assets it's different. We removed OTTI guidance. Even for AFS securities that aren't in CECL, we changed it now to you can write it down and write it back up. So I think as long as you're not going past the original amortized cost, I thought we made a conscious decision that you're always supposed to have on the balance sheet the net amount you expect to collect. And just because I hit a certain number of days or there are regulatory requirements to net things down should not take us away from the principle, which is what do I expect to collect? And it is an estimate that will change from period to period.
Chia,
You want to
waiting
talk first?
patiently.
You have a bunch.
Yeah, I was just going to say, if we want the charge-off rule to be you don't charge off a loan until you are 100% certain it is impossible to collect. If that's not the rule, which I don't think it is, then, I agree with what was said, is that by definition is an estimate then. And estimates change as facts change. And so if I have a borrower that I was pretty sure wasn't going to pay and I charged the loan off, and then the borrower won the lottery, and now they're flush with cash, the recovery that I'm going to receive from them, I don't see that as being any different than the recovery from another borrower who, never experienced, a period of difficulty. Going forward, those recoveries are the same to me.
Gia?
I mean, I think we're talking about recovery, right? So, a lot of your loss data today has embedded recovery information in there based on long-term credit folks' practice. So if you look at the list of recoveries, what's reasonable is what do they do to mitigate the credit risk? Those are the ones that you should be considering for recoveries. So to the point on credit cards, sale of either charged off or non-performing credit cards is part of the credit risk mitigation technique. So therefore, inclusion of that makes sense because it should be part of the loss data information. So, the credit enhancement coming from mortgage insurance, that's part of the loss data as well. So that's why it makes sense to be included in there. So if you're for banking only, right? If you're in the customary credit risk mitigating technique, then you're eligible to include those for the purpose of CECL for recovery, and which is what the data we're going to be using to build our LGD PD model.
Just want to weigh in and agree with something that John and Chip said, and also agree with something that Graham said, even though I think they felt like they were maybe making differing points. I mean, completely agree that the Recoveries decision did intentionally say we're not going to be in 450. It's not a 450 gain contingency anymore. We want the balance sheet to reflect the total cash flows expected to be collected. So I agree it was done very consciously, but Graham, I mean, I think you're right. And I think that I don't want people to lose sight of the fact that part of this decision is making the write-off actually a non-event from an accounting perspective, right? And let's not lose sight of the fact that that's a byproduct of all this. Is all it's going to be is a little net down on the balance sheet, and it's going to go into the credit quality metrics, but otherwise it's just becomes an accounting non-event because we're going to continue to write it up and down. And so, you know, it's almost like charge-off was a little bit of, maybe more impactful from a regulatory and credit quality metric standpoint. But so, I mean, that doesn't cause me to second guess the overall decision, but I do appreciate you pointing out that fact because I think people lose sight of that part of this decision is making the write down a non-event, mostly for accounting purposes.
Yeah, and I think it might, if that's what the board intended, that's certainly fine. It seems like then paragraph 30-1 needs to be amended because what it says is it is an allowance that reduces the amortized cost basis. Those are the words. And I don't know how I can reduce a zero. I mean, I know you can go negative, and that'll be the second question, I guess. But I think it is possible. I think it probably needs to be amended to clarify that was intended because effectively you're writing up the amortized cost basis. I don't know where else in GAAP you do that other than fair value accounting.
I mean, I would just respectfully point out that just because the loan's been written off to zero, it still has an amortized cost basis. It's just zero.
Fair enough. I suppose that's technically true in one way of thinking. Yes, that's true.
Okay, so I'll move on to issue 2 and then I'll recap. This one's shorter.
We'll come back and recap everything. I'm not going to pretend this didn't happen.
So issue 2, negative allowance. So at the June TRG meeting, the staff clarified that an entity could record a negative allowance when measuring expected credit losses. After the TRG meeting, stakeholders asked whether entities could also have a negative allowance for collateral-dependent financial assets that experience subsequent increases in fair value above their amortized cost. These stakeholders noted that if an entity had to previously write down the financial asset, entities should be able to reverse the write-down by recording a negative allowance as long as the negative allowance does not exceed amounts previously charged off. The staff agrees with stakeholders that entities should be permitted to record a negative allowance when measuring the allowance for credit losses when applying the collateral-dependent financial asset guidance. The staff believes that entities should be permitted to increase or decrease the evaluation account so that the net amount expected to be collected is reported on the balance sheet when measuring a financial asset. The staff notes that the negative allowance would not be able to exceed the aggregate amount of previous or expected write-offs. The staff acknowledges that the guidance in update 2016-13 would have to be amended in order to clarify the negative allowances are permitted when measuring the allowance for credit losses, regardless if the financial asset is unsecured or a collateral-dependent financial asset. So the question for the TRG with respect to issue 2 is, does the TRG agree with the staff's analysis that an entity should be permitted to record a negative allowance when measuring the expected credit losses for a financial asset, as long as the negative allowance does not exceed the aggregate amount of previous or expected write-offs of a financial asset? I'll turn it back over to the TRG.
Mark?
I think the question that's being asked is sort of the wrong question. And I think that the question that is more impactful is one that people have already been alluding to, which is how should the cash flows for previously charged off loans be presented on the balance sheet? As opposed to hey, we're going to include cash flows on previously, it sounds like the premise of your question is, we're going to include cash flows from previously charged off assets in the allowance. Should we continue to allow that even when the allowance in total has gone negative? That's not really the question. Even I would agree that if we make a decision to include cash flows from previously charged off assets in the allowance, then we might as well just let it go negative. I mean, there's no reason to stop the allowance at zero. But this question, I think, is an important one of, how should cash flows on previously charged off assets be presented in the financial statements. And I'm happy to say, so last meeting I went through my top 6 or 7 reasons why presenting it as an asset made more sense. I'm only going to hit on a couple of them, so I won't make everyone listen to the whole thing again. But it really is just the right answer from a technical accounting perspective, from a conceptual perspective, and from a user perspective to take the cash flows on previously charged off assets and present them as an asset. So I was listening very carefully this morning as people talked about the length of time it takes for recoveries to come in. Doug, I think you said 10, 12, 14 years later. And Jihao, I think you said the cash flows come in way, way after the charge-off, right? And so I think what you have is cash flows on loans that haven't been on the balance sheet in quite a while. And the big issue here, the reason all this came up is expected cash flows on financial crisis era loans. It just seems misrepresentative to me or distortive to put those cash flows as an offset against the allowance on loans that are actually still on the balance sheet. And I would really encourage us to think about, keeping the allowance, the valuation account, pure to, it should relate to the loans that are still on the balance sheet so that the loan coverage ratio is not distorted and it still has meaning because the numerator and denominator are still relate to one another, right? You have an allowance that relates to the loans that are still on the balance sheet. I think that's important from a user perspective. Fred, I'd be really interested to hear your thoughts on this, whether, that offsetting would be okay with you or whether it'd be more helpful for you as a user to have the expected cash flows on previously charged off loans presented separately from the allowance on loans that are still on the balance sheet. But I think it's an important question for users, and I really do think the right answer is to present those cash flows separately as an asset. It is a contractual right. There are probable economic benefits associated with them. If we think recognition is the right answer, then I would encourage us to think about putting it as an asset.
Chip? Oh, I'm sorry, Fred. Did you want to respond to that?
I'll give it a shot. I'm somewhat sympathetic, actually, to Mario's point that it's charged off, but it's still on the balance sheet at zero. I mean, because there's still a credit exposure, and we all know the banks who have loans on the balance sheet, and some guy comes in, small banks, 10 years later, and drops a check on the table, right? I mean, that does happen. And I don't see why that isn't, it's hard for me to say that shouldn't be part of the overall credit dynamics that we as users see. So, that is a recovery of a asset, although the asset's been written down to zero. And, if some entities are more aggressive about writing their loans down to zero than others, why wouldn't I give that credit to the entity who wrote it down to zero?
Yeah, and I wasn't arguing. I completely agree that recognition should be given to that amount.
Right.
The question is, should the allowance relate solely to the loans that have not yet been written off, so that you can see, for example, what the coverage ratio is, or what the expected credit losses are on the loans that are still recognized, versus offsetting the expected credit losses on the loans still recognized with cash flows on loans that may have been written off 10 or 12 years later, to Doug's point this morning. If you commingle that, you've got a little bit of an apples and oranges effect in the allowance.
I mean, I do agree with that. I think, though, that, you all can correct me if I'm wrong, I think we're always going to have this apples and oranges problem when you're looking at charge-offs and recoveries versus the allowance. I mean, the previous discussion with Dan, it's like, should we account for the recovery if we sell something that hasn't been written off? Well, if you've written it down in the allowance, you should get credit back in the allowance if you sell it for more than you've written it down or whatever. So, I mean, I agree that it would be nice to have those two be clean, but as a bank analyst for a long time, I've never been able to completely separate those two issues, and you kind of have to, they are commingled naturally. At least that's my thought process.
Chip?
Yeah, I mean, I think the question that teed up is a right question. I think it is an important question. It goes back to what I said earlier. I think it's important to understand, how that this concept that we're talking about applies to all aspects of the CECL estimate, whether you're in a practical expedient or not. So I think it is the right question. I think it's a good question that we should address. And just say earlier, I think as I said earlier, we're of the same view that we think that recoveries are recoveries. I mean, one of the things, from a bank perspective, like if you had a loan that you fully charged off or charged down and then it became performing again, I would imagine that what a bank might do is just take that loan and put it back into the pool of performing loans. And so as such, the allowance is kind of a overall pooled concept. And once it goes back to the pool, then, separately calling off a recovery on one loan within the same pool, a bunch of other loans doesn't make sense to us.
Jeff?
I'm going to draw from Wes's playbook, and I just want to say that I want to align myself with Mark Northern's comments.
Doug?
So since my 10-year example has been used so frequently, I do want to establish that there is definitely a bell curve on recoveries, and the 10-year are on the end of the bell curve, but they do exist. Most of the recoveries occur sometime probably between 0 and 3 years after an asset is written off. And so then when I think about that bell curve, I have 2 points. Number one, then we're somewhat creating a lot of additional work and a lot of operational complexity to create this asset, this separate asset that's a recovery asset for what could be a recovery that could happen sometime, that's more likely to happen in the first 0 to 2 years after the charge-off event. So I don't think that necessarily, in addition to a lot of additional work from a preparer's standpoint, I'm not sure that's all that meaningful or helpful from a user's perspective to see that recovery asset all of a sudden appear in that respect. My second point is that you're never also going to get a complete bright line because you have partial charge-offs, and there are a lot of partially charged off assets too. So what do you do with the partial charge-offs? Do you throw the potential recovery on the partial charge-offs into the CECL estimate, or do you throw the partial recovery into the recovery asset? So you're still not going to get this bright line kind of differentiation between the two because of that particular situation.
So, Doug, just a follow-up question. You said typical recoveries are within within 3 years after the charge-off. The charge-offs typically come what period after, excluding credit card receivables for a moment? So
typically, most, excluding credit card receivables, most of the recoveries are based on essentially probably an asset liquidation. And so the asset liquidation typically takes place probably within the year after charge-off. And you guys can, tell me if I'm wrong in that respect.
But how far?
Usually,
But how far off from the origination of the loan? So the loan had some life, and then from there you start the clock in terms of when you charge it off and then recover.
so, it depends on the segment, but I would say more broadly speaking, your loss curves on a whole loan portfolio tend to be relatively high in the first few years and then tail off from there. So, you're generally charging off assets, sometime relatively close to origination and then recovering relatively close to that charge-off date. With the caveat that you have to look at all of the individual asset segments because they all have different loss curves.
I'm just linking it back to the discussion we had earlier about the vintages, gross versus net, charge-offs, recoveries, and does Mark's objective of breaking those recoveries out get addressed through that vintage disclosure? And, in effect, do those recoveries end up in the 5-year columns, or does it end up in the beyond the 5-year column?
I certainly think that helps in terms of the disclosure, because I think
Right.
if you have, if you are breaking out the charge-offs and the recoveries on a vintage basis, you're going to see,
So
a particular event coming through, like the financial crisis. You're going to see that shown very clearly in terms of both the charge-off and the recovery data in the vintage disclosures.
You and I are on the same page here. There's a clear life cycle, and there's a clear pattern of loan, non-performing, charge-off, recovery. And to me, you get that mostly for most types of products in that vintage disclosure, if we go down that route. And I think it solves Fred's problems. And to Mark's point, I'm not certain that you'd get a lot more trying to carve this universe out, particularly in the grand scheme of the balance sheet itself. So, but I wanted Fred's input on that, not mine. I know what my views are.
On the, what's the question?
Well, I'm just wondering, because Mark is trying to go down one path, and he'd asked you earlier in terms of recoveries, how do you use the info? What do you look at? How do you use it? And where's the best place for you to get that information about recoveries? Can you get it through simply the vintage disclosures that we talked about earlier, or do you want some other approach where Mark has his conceptual arguments that he made, kind of breaking it out into this different asset?
Yeah, so I mean, we primarily are going to get our information from not so much in terms of being able to forecast, not so much from the allowance data as the vintage data that just shows us vintage, charge-offs, recoveries, be able to track that over time. If we have that, that's how we're going to estimate ultimately losses and also kind of the adequacy of the allowance that we see on the balance sheets.
And it seems like it captures Doug's kind of timeline of when things happen. You can capture most of that in the vintage disclosures as they're illustrated today.
Mario?
Just wanted to point out, if we go down this route, we probably need to give this a lot more thought. I'm not sure, sitting here today, how easy it would be to sort of pull Humpty Dumpty apart and figure out how to separate recoveries between a recovery asset and the recoveries that belong in the CECL allowance. And to the extent we do break out the recovery asset, is that in and of itself a financing receivable that then needs an allowance?
Right. Yes.
I mean, my observation is that, I have a lot of sympathy for what, Mario, you just said about burden and splitting it out. But to me, the booking an asset has appeal because essentially what you're saying, particularly, Mario, in your case where you're talking about regulatory rules, really what you're saying is I do have an asset, I've got a loan. And so, the net of all this activity is I still have a loan that I expect to collect versus, having it as a negative asset. But it did strike me then you'd have to be evaluating that asset for its continued recoverability, particularly since it's related to an already charged off asset.
All right, Graham?
I promise not to kick the hornet's nest too much. I guess, so I think it would be helpful if, it sounds like the discussion's kind of, leading towards, well, I guess, let me clarify my initial view. So my initial view is that part of this is driven by unit of account versus unit of measure of the allowance. And I think I've always been comfortable with including expected recoveries within the concept of a pool, so long as that doesn't drive the overall allowance negative. I do think there needs to be a cap somewhere in the allowance. It sounds like perhaps that's charge-offs and future expected charge-offs, it's kind of a low-com concept, I guess, sort of more or less. It would be helpful if if the board would consider articulating why this valuation allowance is different than others. We've heard some people, I think we're concerned that some other people may look at other valuation allowances against amortized cost bases and kind of think, oh, this is the general thinking of these things. But so again, not against including recoveries generally, just I do think that the cap seems to be the amortized cost basis. That is the notion of the allowance, is that it reduces that. So you'd have to amend 30-1. But I think, you know, if that's where the board intends it to go, obviously that's fine. But it would be helpful also to think about why that's not, you know, they've also included the guidance or the language around contingent gains. And so that would need to be struck as well. I just think there's a lot of changes that would have to happen, and it would be helpful if they would articulate the reasons why this is distinct from other places where we have valuation allowances and GAAP.
Gio?
Yeah, I mean, first of all, I don't know how material this is to everyone around the table. I just don't think this is a hugely material item, at least from my perspective. Haven't encountered that much of what's called negative, that the Mario math, right? Right. So it's positive. I'm just kidding.
He's got a spreadsheet he can show you. He showed it to me.
And conceptually, I agree with Mark. And like, I'd like to see it in assets because I don't know how to define a negative contra, right? So, but if we be practical, and if you put someone who's more enthusiastically charge up their loans and later on have recoveries versus people don't charge up their loans as much, if you want to put them in an equal footing, is a disclosure help. So say within my total allowance, X dollar is actually negative that's in there. So when I do the calculation for my ratio, I can exclude them, so I can put everyone on equal footing. So then we can move past the assets discussion because to Mark's point, you should not get benefits for the lower allowance, right? And to your like your denominator and numerator are not matching in a way because you're covering something that's not even in your denominator, right? So, is that right?
Okay.
It's a lot of math, so.
Okay, we like math. So I'm trying to envision the disclosure that would go around this. So we've carved this asset out that Mario's told us has zero amortized cost. You've got a recovery.
Yep.
Are you going to tell me, you're going to give me some context around this asset that is going to be on the balance sheet?
Yep.
Are you going to tell me the underlying original loan amounts for that asset or something?
All I'm saying is how much that your negative is associated with charge-off loan balance. So charge-off means I have
Okay,
zero
so
to Mario's point.
you would give me that number, since it's already been charged off, you'd give me that number as a disclosure?
No, not the amount I'm charged off. I'm saying, so for the loans that's charged off, how much is the negative balance associated with that?
Yeah.
So when I do my calculation for coverage ratio, I can exclude that from the
I
calculation.
would want to know what the original amount charged off was, if you went down that path. I'm thinking from an analytical standpoint, otherwise I don't have any context for that number. It's a number sitting there, I'm not earning anything on it, I don't know
I
how it's
understood, but-
expanding or contracting over time and what's driving it.
Yeah, but in that, what you're doing right now, though, without the disclosure, because you have nothing in your denominator that reflects anything because it's already zero. You're already doing that. All I'm saying is just call it out how much it is.
Yeah.
Because you're already kind of not wanting to know what's associated with those loans.
I'm
right?
showing my bias, I generally ignored the recoveries, because they were so far after anything, so.
Okay. Like,
Mark? I've got a couple of quick points just to respond to three of the comments that were made. In terms of the degree of difficulty in carving this out, I think that to do this accounting that's being proposed, this number is already going to have to be sort of forced in for a lot of companies into the allowance model as almost like an on top. Because I think what a lot of companies are going to do is they're going to do a study that says, what do I think my lifetime net loss rate is going to be, right? They'll come up with a lifetime net loss rate for loans, and they're going to apply that to the loans on the balance sheet, okay? But under this accounting we're proposing, that won't be enough.
Yeah, well,
No, it won't, because you've got to add in the expected recoveries on
that's
loans.
part of the net amount collected.
No, but if you do it, if you look at your loan balance and say, what do I expect is going to be my net loss rate on that loan balance, that's going to tell you the expected charge-offs and recoveries on the loans that have not yet been charged off. And so the recoveries on loans that have been charged off, and think about these financial crisis era receivables on the credit card side, those aren't going to be in your net loss rate, the fact that you're still expecting material collections to come in on those. And so for a lot of companies, that's going to have to go on top after the loss rate's been applied. And so carving that out really shouldn't be a big challenge, I wouldn't think, right? Because you've had to kind of force it into the model and say, okay, I've come up with my net loss expectation on the loans I still have. Now I've got to come up with a recovery expectation on the loans I no longer have because they've been written off. So I wanted to touch on that just in terms of the degree of difficulty in pulling it out. The recoverability and would I need an allowance against the recovery asset, I would agree with Mario that that doesn't make sense. And so we'd have to come up with a rule that said, could effectively, this guidance would have to be written that it's part of the allowance accounting, it's being presented as an asset, and so you wouldn't put up a separate asset against it. I mean, that would just seem like that would have to be part of the overall solution. And then somebody asked about partial charge-offs. I don't see partial charge-offs as being a big challenge, right? I have a loan of 100, I wrote it down to 60, I now expect recoveries of 80, and so all I'm saying is it doesn't really make sense to say I'm going to have 60 of loan and a contra asset of 20 for that loan. If you put that 20 up as an asset, so now I've got 80 of asset, that's just closer to where it would have been if you'd never had a write down, if you just stayed in an allowance approach, right? So it does make sense from an overall sort of theory perspective to avoid the contra and just record it as an asset, because it just puts you closer to where you would have been as if you hadn't, taken that write down in the first place from an overall balance sheet perspective.
So Mark, just on your point about no allowance on the asset, I guess, so your estimation of what that is could change over time, just based on your estimation. So I guess that number, I assume, would change. Maybe you don't have an allowance, but you're resetting it whenever you're redoing your allowance.
You would have to re-estimate it. You'd have to re-estimate it. Because those are the cash flows you expect to collect, and part of the overall accounting for the allowance.
Mark, and I'm sorry to put my analyst hat back on, but how am I going to get visibility into this number? Is it going to be linked in some way to the roll forward of the allowance that we have today? Or would it have its separate allowance, or roll forward? Or I'm really struggling with how to have visibility into this number. Otherwise, I see this number that expands and contracts, and I don't know anything else about it. It doesn't link to something else.
Well, it's not going to link to anything if it's offset in the allowance, though. So you're still not going to, it doesn't link to anything, because as Jihao said, it's not going to relate to a balance sheet amount as it is. And so what that is going to tell you is that is sort of, it's almost like a runoff portfolio, right? Those are previously charged off assets, some of which were written off a good time ago. And it's sort of, it is just the expectation of cash flows that are separate and apart from the cash flows related to the loan balance that's still left.
If I can't see the flows in and out of that particular asset.
You would need a roll forward.
I would need a roll forward.
You would need a roll forward, yeah. A roll forward of the recovery asset.
And this seems like, because not every charge-off is going to go into this asset, and not every recovery is going to go into this asset. So it seems like a lot more bookkeeping for minimal value.
There's a lot of bookkeeping that's already going to have to, this would not drive any additional accounting. Then all it is changing the presentation. I mean, the question about requiring accounting for future recoveries of loans that have previously been charged off, that's a question. That's a recognition question. Once you decide you're going to allow that from a recognition perspective, there's not really additional accounting complexity to presenting it as an asset. The accounting complexity comes with deciding to require an entity to put recoveries of previously charged off amounts on the balance sheet and taking away the historical practice of cash basis. That's where the complexity is going to come from, because now you're going to say you got to go from cash to accrual for expected recoveries on previously charged off assets. That's the complexity.
Chip? Yeah, I was just to make two points. One, I mean, Mark, I think the reason you said that it doesn't make sense to have an allowance against this freestanding asset is actually the point that one of the points we like to make is, the reason for that is it isn't a freestanding asset. I mean, it's not its own unit of account, it's part of something else on the balance sheet. And so it's not a separate unit of account, having it separate on the balance sheet, we struggle with. But on the partial charge-off issue, I think the other area of the complexity that in your example, Mark, that we missed was, you had a loan with an allowance of 100, you charge it down to 60. That loan probably will still have an allowance. So it'll have 60 in an allowance. So now you've got a recovery that you would still have to figure out how to bifurcate that recovery by what relates to the allowance versus the charged off. So it seems like a lot of complexity for, not a lot of value. And I think, Fred, what I heard you say is what I've heard others people say as well, is the allowance coverage ratio is an important ratio, but it is not a perfect ratio. And there's all kinds of things that go in there. Just the fact that different people have different charge-off policies make it kind of difficult to compare. So I kind of feel like we're looking for some kind of theoretical purity that just, on this coverage ratio it's just not there.
I would just, to respond to that, I would say I agree with that. The other issue why I don't have a problem with the negatives is because we're very focused on the balance sheet here, but banks and analysts care about the income statement a lot, right? That's day-to-day focus is on the income statement, what the reserve level is going to be. And it seems to me if you through the reserve you have charged something down or taken the mark on it, I don't see why it shouldn't then go back through the reserving process rather than a markup of an asset. In my mind, that would be just make users very confused if we somehow separated that in any way.
Doug?
I guess I don't want to beat a dead horse too much, but I think I'm just trying to think of how I would explain this to a shareholder. And I would try to say, well, we have the CECL allowance that is supposed to take a look and take into account, as we discussed earlier today, the expected charge-offs and the expected recoveries, and include that in my CECL and allowance. And so we're including expected recoveries on the asset in the allowance. Oh, and then I also have this separate asset here that's a recovery asset that is an asset based on the recoveries I expect on fully charged off and/or the question is still open on partially charged off assets. And that's separate from my CECL allowance, but it's somewhat related. I think that gets really complex to try to explain to a user or a shareholder, particularly a non-sophisticated shareholder who's going to have some challenges with the allowance anyway.
Even the supposed.
Hey, this is Tim. Can I jump in here? I couldn't agree more with what was just said. I mean, I think we're getting way past what you actually can know to these recoveries that are coming years and years and years after. You can't possibly, no one has crystal balls. You can't estimate these things. So creating a system to do that seems to me really out off the edge. And if we're doing the CECL calculation correctly, like was just explained, then any normal type of thing is going to be included in that. What your experience has been, and we talked about this 1 to 3 year cycle and things like that. These things that are way beyond the norm of what you can reasonably estimate, isn't that some kind of special disclosure you just have to make and explain it? If you get some kind of a thing like that, if it's an ongoing thing, it's going to be in your CECL calculation. If it's not ongoing, it should be explained separately if it's that significant.
Thanks, Tim.
Thanks, Tim.
Cool.
All
right. So I will try to recap all of our recoveries and negative allowance stuff.
Right.
So bear with us. So I'll start off with the negative allowance, since I think that was a little easier. So it seemed like to me that most folks agree with having a negative allowance. Okay. And that if there was a negative allowance, it would be capped almost to previous charge-offs or expected charge-offs. A lot of nodding heads. Okay. And then on recoveries, there's a little bit of mixed feedback, so I'll start with most folks seem or are of the view that the guidance is clear after we strike out paragraph 35-8, and that there are no other changes that would need to be made. So that's one view. But then the other views are, there are some clarification, I'm coming, I'm turning. And then there are some other views that are, the guidance should be clarified and that the recovery should be better explained in CECL. And then I think, Jeff, you had a view of defining performing and non-performing. Did I miss anything? Or?
The other thing I would say is I think there's more guidance to be clarified. There seems to be two different perspectives. One, there's more guidance that needs to be clarified in the recoveries. I think others said there's probably more guidance that
It's 3-1, and then you'd have to do it for the collateral maintenance, collateral dependent.
Yeah, and I had one question about where we came out or what the view is on including cash flows, let's say for sale of NPLs. So you have not, where you have not had a charge off, and how we're looking at incorporating cash flows when you have not had a charge off. Just clarity on kind of where we ended up there.
So what I heard was that that the guidance is clear that there are no changes that need to be made on non-performing sales of financial assets because they'll be able to get it on their own. They'll be able to figure out on their own that those shouldn't be there. So I was of the view that there are no changes for recoveries at all.
So did you just mention that you could not include cash flows from sales of NPLs? So that I wasn't clear where what the view was, where we ended up on that.
Yeah, I thought we should.
Yeah. I think we said if we reserve for it, right, then you can include that sale of non-performing as a proceeds against what you reserve. So that reserve is almost just like the charge off. I think that's the discussion over there, like Dan said.
Yeah.
Okay, and I think I think you mentioned something around customary. Like, so to the extent that you have sales as part of your customary risk management, and it seemed like it was in the context of that.
Yeah,
Routine and customary sales.
I think for credit card, the sale of non-performing loans are pretty normal. Can I dare ask one question of the three of you, like, without jeopardizing TD being examined? Like in the
yeah, that's what you say. I have a question from a friend.
Wells Fargo wanted me to ask this question.
In the context of CECL, like, would you reconsider, should there still be a concept of charge-off? Like, this discussion shows that charge-off is artificial.
That is the problem.
Is an artificial threshold, right? Because, like, if we don't have charge-off, negative won't even come into play. So that's what's triggered in a way. But I know the reason why we had it before, but CECL is a continuous expected life cycle losses, right? So charge-off doesn't really fit into that bucket.
Well, we need a charge off at some point, right? Because if the loan's like deader than a doornail, we can't keep carrying a loan and allowance balance forever. So there has to be some mechanism of being able to collapse the balance sheet, right?
But,
So
understood, but charge-off today is not a accounting concept, right, in a way. Like, there's no.
Sure it is.
No, not exact right off, but not. It's.
Isn't the regulatory guidance, correct me if I'm wrong, just an interpretation of the accounting guidance? The accounting guidance says this is when an asset becomes uncollectible.
Not really.
No, this one is.
The regulatory guidance is passage of time.
Yeah.
Right.
On the consumer side. There's more judgment that you can apply on the commercial side, but not really. I mean, there isn't a lot of judgment that we're allowed to apply.
You know, as
when we
well,
charge
struggle
things off.
NTD. So.
But it would be the way we, at least whether anyone agrees with it or not, it would be the way that we think about operationalizing the phrase or, the sentence in GAAP that says you should write off or charge off when it becomes uncollectible. That's how we would operationalize it.
And we think it's often difficult to suggest that it's collectible when they haven't paid you for 6 months. So, I mean, it's trying to make it easier for you guys to not, you're not going to look at every credit card and say charge off or not. And I think it's really, really important to have charge off policies to be able to compare allowances among banks. Because if you've got somebody that never charges off, how do you compare they look like they have a huge allowance, but the bank that charges off really quickly might have a smaller allowance, but really be in better shape. So for us to try and see across the industry, it's very important to have uniform practices.
But why require the full charge-off like in credit cards? Why not just charge off what you don't expect to collect?
I mean, what we have heard is the timing part of it seems like that's pretty, that you guys have found that to be pretty acceptable. It's where it gets to the amount of the charge-off, like for credit cards, where, in particular, this discussion on recoveries probably is coming from.
Exactly. Yeah, that's causing a big piece of this issue, I think.
I think the credit risk people are well aware of the concern that's been expressed. Their willingness to change, that's up to them.
I mean,
That's not an accounting policy.
Maybe a year ago, the issue of our charge-off guidance had a lot of energy. So that was something that you guys were talking to us about quite a bit. And then it seemed to kind of die down for a bit. But we have highlighted that as a piece of guidance that we should be looking at in addition to all the other guidance that relates to the ALLL to update it. And so it is something that our credit risk folks are looking at. It seems like it seemed to me, at least, that the urgency with which you are wanting us to prioritize that has died down a little bit. But to your point, that is something we'll be looking at.
I think that's a fair comment, Joanne, but I think it's because we've come to this, what we thought was an agreement. So if we're not relitigating the ability to consider recoveries in your estimate of cash flows you expect to collect, then, I hate to say that the regulatory guidance is less important. It's important, and for the reasons that it's important on the regulatory side, but from a GAAP perspective, it becomes less important because the allowance reflects the cash flows we expect to collect. Whether we've charged it off or not is sort of irrelevant.
Yeah, and I think, maybe, I apologize, Bob, for jumping in, and I may be speaking, I'm speaking for all of us, but please disagree. Yeah, I feel like on the, please, after I've said what I'm going to say, you can disagree. No, I think as it relates to what we think of as recoveries, which is you have a charge-off, and then you have an expectation of cash flows after the charge-off. I think we have thought about that and feel like that's, consistent with the standard. So if you were to ask us, were we communicating today any reservation on that? We are not. Now, the idea of you don't have a charge-off, and then here are all these different situations that might occur: increase in collateral value for non-collateral dependent, or sales of performing or non-performing loans. I think that's a little different than how we've thought about recoveries in the past. But to the point about charge-offs, I think we're comfortable.
I would just add, I think from a supervisory examination standpoint, the key thing they want to look at is what amount of the loans does the bank believe is collectible, which is why if you've taken charge off, you've already reduced it to some collectible amount, at least at the loan level. Granted, collectively, there's going to be some losses that'll occur, but I think looking at how much the bank is viewed as still collectible hasn't met the uncollectible threshold, whether it's based on days or a specific loan-by-loan analysis. That's a key thing from the way our examiners look at credit risk. From a technical standpoint, and depending on where you're going to go in any clarification, when you talk about cash flow, interest and principal from the borrower, does the borrower, as you view it, encompass guarantors? Because we see on a lot of loans, commercial type in particular, where cash flows from guarantors are another source of repayment, particularly after a charge-off. They shouldn't be ignored.
It's part of the same account.
Yeah. So I think there's a paragraph within the standard that it gets into freestanding or whether it's attached to the loan itself. If it's attached to the loan itself, obviously that gets included. If it's freestanding, there's a paragraph within the standard that precludes you from accounting for that.
I think we would be looking at where it's the guarantor is part of the contract, which is not an uncustomary practice for
If it's part of the
commercial type
contract
loans.
and travels with the contract, then it's included.
I would think so, but the
Yeah.
description and the write-up never mentioned guarantors at all, which is
Okay.
the reason for asking.
Yep.
Yeah, and one point I wanted to make, because I think there was some reaction to when Jay said that he didn't think that there needed to be any standard setting for recoveries. I think most of the reason, and obviously the discussion here seems to be different, but when we did outreach, the vast majority said that we didn't need to make any change to the codification, that recoveries were understood. So that's kind of, I think, where it's coming from. It seems to be a different discussion today than during the outreach. So that's kind of maybe where the confusion is of.
Yeah, I mean, and just to put a finer point on it, I mean, the way the staff has always viewed this is when we look at this, and this gets to some of the comments around what's the difference between the measurement here versus some of the other valuation allowances that are out there, and why is why is the board okay with, recoveries here and so on and so forth? I mean, the way the staff has looked at it, and I don't want to speak for the board, but we've had discussions with them, obviously, is that this is about cash in and cash out. And we're estimating the net amount expected to be collected on the balance sheet. And that includes all cash in and all cash out. And it's an expected model. And so I can appreciate some of the comments around, that's not what we do today. I understand that. We also don't do an expected loss today. So that factors into how we make changes or how we propose changes to the board within the codification. And I completely appreciate the fact on the negative allowance and making it clear within the standard that you can have a negative allowance. And I think that we've already got teed up amendments to make that clear, and it involves making changes to paragraph 30-1 that says you can take it down or it can add to or
There's
subtract
language.
from. But yeah, I mean, we've got language around that to make that clear. But, I think that what we struggle with is that when we hear from outreach, and actually a lot of the folks here, that it is clear, and that as long as we clarify what we mean by negative allowances, we would struggle to come up with what exactly we would write in the standard that wouldn't then cause more confusion, I guess. Given that the entire standard is pretty flexible. So I just wanted to say that. So if there are those of you that are thinking that there are going to be paragraphs and paragraphs proposed to the board to add as changes to Cecil itself, I don't foresee that happening. I guess reactions to that, or
Yeah,
Shane,
I mean, I think
Shane, you're crazy. Yeah,
my
it's
only
okay.
thing I would note is at least the way most of us read it from the, I'll say, regulatory side is we did interpret recovery as meaning you would need to have a charge off first. And then in your paragraph 30, you do say the staff also notes that because an entity could not record a recovery without having an expectation for either future charge off or a previous charge off. So if you are thinking about, so I just mentioned that. So when you mention recovery, I would read it as limiting it to anyway, I would limit it to that situation, not NPLs. Like I wouldn't then have said for non-performing loans, if I have a plan to sell, include that in the cash flows. I just would not have assumed that. So that's how I think about why clarity would be helpful.
Yeah, Shane, just two comments. One, I mean, if you were going to do anything, you could put in like recoveries, like for example, payments from the borrower, collection of collateral, sales of non-performing assets that are, you could do like one of those things, or I mean, whatever you have, I guess this is going to go out for exposure. So if people have suggestions, they could, I guess, do it through that process as well.
That's right. I mean, whatever changes that we make, obviously, we're going to take from this meeting, incorporate it into the exposure draft, and it will go out in the exposure draft in mid-November. So, if there are suggestions on where we can provide more clarity, again, if that's in the form of some sort of a for example, we can do that. I'm happy to hear that feedback. Do you have anything else
No, that was
on
it.
recoveries? So anything else on recoveries from anybody? Okay. Is there anything else that anybody else would like to bring up on any other issue that we haven't covered here today? Are there questions from previous issues that maybe you were talking at lunch? Anything come up? Okay, well then that ends the TRG. Thank you all for coming. Thank you all for participating, and we'll see you next time if there is a next time.